All right. Hopefully, you guys are all ready for this. Gratz Force has a whole to being over 700 members. All right, we're going to go ahead and get started, and I will see what if anybody else joins. They'll just I'll admit them then. All right, so we all get in here tonight. We got we have 5 folks live. So see iPhone Nick, Armel, Austin, Robert. All right. All right. So first of all, welcome to Armor Bull Trading. This is the spread class. I'll try to have if you guys post anything on the little chat box, should be able to respond to you pretty quickly there. So put it right there. I don't mind you guys being off mute if you need to ask any questions or anything like that. If it's something that pertains to exactly what I'm explaining at that moment, of course, feel free to ask the question. If you type it, I'll probably see it after the fact. Just so it kind of flows better. No worries. It should give me a little flashing icon. So, alrighty. It's 11:07 p.m. here on the East Coast. We're heading to 1 a.m. roughly, give or take, 15, 20 minutes. How in the hell could a man enjoy being awakened at 6:30 a.m. by an alarm clock, leap out of bed, dress, force feed, shit, piss, brush teeth and hair, and fight traffic to get to a place essentially you made lots of money for somebody else, and rest to be grateful for the opportunity to do so? So this guy clearly had a pretty clean sight on, working for himself. Today is March 14th. You are getting the master spread class. We're looking at debit spreads, calendar spreads, and a few other spread types that I trade on occasion, but I really prefer calendar spreads and debit spreads. Calendar spreads being number one, debit spreads being right there in line. I have no issue trading naked options. All these things are kind of pertain to each situation. Every stock is different, so all those things need to be considered when it comes to making positions. So before I get started, I'm just going to mention the disclaimer. Obviously, anything in this recording is not meant to be taken as direct financial advice or any, advice to trade, open any trades, trade any stocks or options that I mentioned or talk about in these. A lot of these are past examples, but we may talk about future examples later in actual live charting and stuff like that, which of course I have no issue with. And I just want you all to know that I have a very high risk factor for my trades. I don't mind certain situations. So if you have a small account, if you're, really nervous about the market and things like that, then obviously you need to take one step at a time. Some general advice as far as trading goes: don't open too many contracts at the same time. Only trade what you can handle. Don't open too many contracts on different stocks at the same time, because then you're unable to really monitor all of these different stocks. So between 3 and 5 positions max. Once you get up to like 8, 10, stuff like that, it kind of gets carried away. If you're really comfortable, in trading, then those things come a little easier. So, I can have 8 to 10, open at the same time on different stocks. But majority, if you have been in Armor Bull trading for any amount of time at this point, you know that I trade longer expirations. I preach trading longer expirations because I know the risk factor is in trading short term. If you're day trading, if you're scalping or things like that, obviously you can make money on short momentum moves, volume spikes, the Greeks manipulated like implied volatility on things such as earnings and stuff like that. You can clearly make money at any situation in the market. But if you hold a position too long, if you put yourself in a negative position, say you bought at the high of day, you were up profit, but you can't sell it because you don't have any day trades left, or your good faith violations hit, so you can't rebuy or things like that. You need to be aware of those situations on your own account. It's not any brokerage's fault, whether it's TD Ameritrade, Robinhood, Fidelity, Chase, whoever it is that you use for trading. So keep those things in mind, and then here we go. So debit spreads for beginners. Parts of a debit spread are the most important, and I'll read a lot of this, but I'll let you guys read, some of the longer pieces. So debit spreads the most important are the same as what is important on negative position. So calls and puts are direction. and expiration time that you think it will need to take place. So they're directional mostly. You really need to have an above neutral area. So in the example you see here for SPY, this was last year going into the beginning of 2021. So you're looking at December 18th, 2020 expiration on this example right in front of you right now. Can you all see my screen?
Yeah, we can see it.
Okay, and y'all can hear me fine, I guess. Excellent. Okay, so 259 to 258 puts. So these are debit spreads, right? And you can see that I have a lot of them. There's 200 total contracts sets, but there's officially 400 contracts open. So there's 200 buys and 200 sells. So anytime I share a screenshot that shows the position broken down, it's going to show, like if I click on SPY, it'll actually show how many contracts there are as a whole. I think I have something that has multiple contracts on it open right now. I'll show you shortly. So let's continue here. So what you're looking at is the SPY 259, 258. So the very simple basis of this position is that we need to know the difference between 259 and 258. Well, in all sense, that's $1, right? So options money, you always multiply it by that 100 share factor. So that's actually $100 from 259 to 258. So do we need this? You see how cheap it is. It was $4, right? Average cost was $266 roughly per contract set. And what I needed it to happen was for SPY to drop to any substantial amount at that time. It was still 338. We're clearly way above that now. Let's see. Please for a new link. I'm logged in on my phone. I'd like to use my laptop instead. The same link should work. 2 seconds, guys. Yeah, this is one of those things. Like, so I don't want to, be sharing this Zoom and then I sell it or share it with all these other people, and yet it's got interruptions like this or stuff like that. So any kind of stuff like that, I don't want that to be on every single one. You know what I mean? So that's why all these classes I do are live. The only people that get the recording are actually the people who participate right now and that have purchased it up to this point. I did share it in the full chat, but people that didn't actually pay for it, if they somehow slip in, they won't get the recording. Let's see. So there we go. Get that out of the way. All right, back to it. Okay, so what you need to know about debit spreads. So they're multi-directional, up, down, or sideways. So again, this is what I was talking about, sort of neutral, because you can set these up similar to credit spreads. Credit spreads, I do not trade. I traded them for a roughly 6-month time frame, and the first ones I did were on Boeing. Tremendous return. It was $1,500. Except it had a huge run, and it just made it all better for me. I collected premium instantly, within that short amount of time that I had that position open. However, when you attempt to do something like Tesla with a credit spread, you can very quickly lose all of your collateral if you're not careful. And this is even being way out of the standard deviations for Tesla's general move. So if Tesla normally moves 50 to 100 bucks, within a few day range. If you're outside of that range, chances are you're not going to get hit with it. But in my situation, I did, and I'll explain that a little later. So what you're looking at is debit spreads are max profit and max loss up front. So whatever you pay is your max loss period. Your max profit is the distance between the spread. So right here, as we talked about, 259 and 258, we know that's $100. Well, if I paid, we'll just round this up to 3. We know that my profit potential is $97. So 97 plus 3 obviously creates $100. And with that being said, the more you have in this scenario, because I had a lot more expiration time on this than general. I think it was 2.5 months away when I first opened it, and it was, let's see, I think SPY was at like 345 or 350 when I first opened the position. Election time was coming, and that's why I got this sort of spike here. And you'll see actually it was up a pretty decent amount on a later slide. So 259 minus 258, that's $100. We pay $3 per contract. I'm just rounding this number up. Once you pay that, you know that the max I'm going to lose on this contract is, $3, right? The max I can make in the event that SPY dropped all the way to 259, 258 area. At 258, that sold is going to hit, and we're going to be at full profit once it expires. However, it does not need to be in a debit spread because you've already received the credit. It does not need to be at 258. That is optimal, but you're still going to receive full credit because you already received the contract. In the event that you get exercised, all you have to do is, if you get assigned on your short contract, you will actually exercise your long contract. And since I'm 259 over 258, that means I had a better price point than they did. So if they do exercise, or assign rather, it's not a big deal for me because my other contract completely wipes that out. Okay, and y'all need to know that because when you're trading debit spreads, in the event that you get exercised or assigned, that's all you have to do. You just simply exercise your other contract against it as long as you do it before your expiration time. So if you'll notice, these are both on 12/18 expiration. You lose your rights to that contract on that expiration date. So in the event that SPY does drop down to some obscene level like this, and you get assigned after hours, you have up to, I believe, 5:45 or 6 p.m. to actually Eastern time to actually exercise your other contract. If you don't, for whatever reason, and you get assigned, then you have to worry about covering any margin balance or shares, things like that. So pretty much don't let your contracts expire. It's very simple not to do that. If you're waiting around, say your profit right here, say SPY did in this example drop to say 259 or 254 or something like that, and you're like, oh, there's no way this is not going to be in the money. Well, maybe it jumps back up to 260 on that Friday, and guess what? You just lost the entire position because if it expires out of the money, it's just like a naked contract at that point. It's not worth anything. Okay, you don't have the rights to the stock price at that area, and neither does the person that you sold it to. It's completely washed. It's garbage. So with that being said, if it did get down to even 270, and I'm showing maybe 50 to 80% worth of value on this contract, so say, well, for simple terms, $60 to $80 worth, per contract, I've already made a huge profit. If I only paid $2.66 per contract here, then I've made a massive profit. Why in the world would I hold to the expiration date to try to catch a few more dollars? You know what I mean? Now, at 200 to 400 sets, obviously that is a decent little chunk of money there. You can see right here that, showing $4, I'm already up $268, 50% on this very small, contract set. So those things that you need to be aware of. Again, for whoever just joined, things they are. So multi-directional, up, down, and sideways, max profit, max loss. You need to make sure you build the spread correctly, and we'll go into that in a minute. Make sure you're not at risk for dividends on the sold contract. Otherwise, you may be assigned, and that's where the extremely rare case comes in. I've never been assigned on a debit spread in 2 years of trading them. At this point, it's more than 2 years. It's about 2.5, 3 years of trading debit spreads, particularly. Easily over 1,000 total spreads. So looking further into the example, you can see that, just that $1 move on the SPY debit spreads, that it actually ramped my profit up $468, 88% off the rip. And I could easily have sold it for that. And then you got a very next example. You're looking at almost $1,000 in profit there. And I was waiting on the election to go completely the opposite way of what it did. And if you want to read right there on the right, this is actually pretty much exactly explaining this very scenario. So take a minute, go ahead and read that. I won't read to you like a teacher with a bunch of kids. So go ahead and just read that for a minute, and I will continue. I'll give you about a minute, just so you can look over it. And please ask any questions that you see on the screen right now if you have a question. So go ahead, take 1 minute at 11:22. We'll hit back.
Trail went cold about 100 miles. Now we have to retreat.
Yeah, I actually have a quick question.
Yeah, go ahead.
So, how does implied volatility works on debit spreads? Is it like it's way less than naked options I've heard, or is that how does that work?
That is true. Um, and we'll talk about calendar spreads later, but debit spreads particularly, they can still be impacted by implied volatility pretty hard. You know, if you hold it up through earnings and stuff like that, even if your expiration is like 3 weeks to a month away. I did this with Netflix, and it burned me pretty hard at first, and then I averaged pretty deep into the position. Eventually, Netflix finally did hit my price target, but by that point, my contracts had already expired. So if you're going to play earnings using debit spreads, because I'm assuming that's why you're asking about the IV, or are you
Yeah.
just mentioning in general?
Yeah, I mean the earnings specifically because I was wondering. So, like every time I entered like I heard people entering like earnings, they would like do debit spreads instead of like naked options, so they wouldn't get like completely wiped out.
Right. So the good news is your contract's still going to get hit. I'm not going to lie to you, because what happened with Netflix is I went for it was at earnings, and ironically enough, this last earnings they had, they actually went way hard. But before that, it was the time they dropped almost $80 a share from 530 at close to 450, and then ramped back up to about 465, 470 at the next open the next day. So I think my contracts were, I think they were around $100 and something each for the debit spread set. That was 580, 570 to 580. So $1,000 spread total that I could have made off the 100 and something dollars. The value dropped down to $4,000 total from 10,000. So it was $40 roughly. So it went from 115, I think it was about 115 per contract, and it dropped all the way to about $45 per contract set. So with that right there, and I had 3.5 more weeks to go for the expiration to hit. So because it was in that less than a month area, implied volatility still impacted those high built IV contracts pretty hard. So it lost easily 60% of its value. And then of course I just monitored Netflix, made sure it stayed around that 470 area, and I continued to average in and average in and average in. For me, this was 2 years ago now. This was a big mistake because the whole position ended up expiring worthless. Um, and the reason being is because I really was dependent on my technical analysis. And matter of fact, while I'm talking about this example, let me see if I can go back in time and find it, and I will explain exactly what it was I did. Let's see, where are we at here? That's 575, and that was July 20. Yeah, so I believe it was right here. And let's see, earnings. Yeah, this is when it was. Okay, so I had, let's see, September 4th would have been money, because September 4th was the initial expiration I was going to buy, but I had faith in Netflix outperforming due to COVID, right? Um, so had I had the September 4th expiration, I would have made all the money I expected to make, because as soon as it broke this price point that you see I built in here, it blew out exactly like I thought it would. But the only problem is my expiration was too short. Had I bought the initial September 4th, I would have made roughly $50,000 to $70,000 on this one trade. So I did lose $13,000 on the trade, but to me the risk was pretty implied versus because I knew once I broke back over that position, I knew the stock was going to run. And even if I didn't get full profit potential on the trade, I could have easily sold it for probably $20,000 to $30,000, and that is accurate. The irony is that I had so many contracts that all of that quantity makes up the return. So just as if you have a naked contract on Boeing the other day, it went from dirt cheap like $20, $30 contracts to thousands of dollars. So with those kind of things, those moves do happen. Do be aware of implied volatility. So this move happened. This is right before I did it. And I figured, honestly, since it was already down in this area, this was the day I opened them up. I was actually up $3,000 on the position before it actually went out on me. So then they closed. They gapped way down here. It actually, so pre-market, see if I can look at 4 hours. Go a little further. And let's see, where was that low? Dun, dun. Oh, it's not showing me that I went to 450 here. Interesting. 5:30. I wonder why it's not showing because I actually watched it when it was happening. Let's go. Let's try 150. Bear with me 2 seconds here. And what you see all these EMA cross up, down, and all this arrows and all that, this is actually my scanner and Sniper scanner both combined on these charts. So, and this is showing aftermarket as well on this particular chart. Let me hit 2 hours real quick and see if I can get what I want. Yeah. Yeah, there she is. So 450, 449. So that was actually on the 16th on that earnings. So so you don't think I'm crazy. There's the candle that actually I watched it happen on, and then the very next day, it already got way back up here. However, the implied volatility got murdered here, right? Because if you just look at how high the drop is. So right there at close, you're looking at close at 527. High of day it was 535, and I had faith in it at that point because I was like, man, she'll easily blow back to 560, right here, and we'll get my money big time. Because all I had to do was get to like 555, 560, and I would have made plenty of money on the contracts because the implied volatility at that point would have dropped down so much due to it going in my direction so hard that everything would have been fine. And again, with debit spreads, you're not looking for huge home run hits. It was the quantity that I had that was going to make it a home run. If in particularly the contract itself had only bought one, it would have been a $40, $60 loss worst case scenario, and I would just close it out. But because I chose to average in, because it tested here, I'm still holding. My expiration's still good, and came on back down, and I'm just like, great, here we go. I'm just getting wrecked. So I kept averaging down here, and then sure enough, got closer and closer to my August expiration. Tested again, not going to happen. Come back over here, test it again, and this is right around where my expiration was, and it just completely got wiped out. So it got here, and it just could not handle it. This was I think my last. I can't remember the exact expiration, whatever that Friday was, because I saw it test again, and I just got destroyed. So it just didn't hit, and the whole position expired worthless. So with those things, you have to keep that in mind. So implied volatility is going to still hit, but it's not going to hurt as bad. So if you can get a contract for, say, $50 versus a naked contract at $200, I mean, let's be real. If you're looking at the risk factor, okay, if my $50 contract on a $500 or $1,000 spread at expiration day turn around and gets in the money the next day, it's going to have a value. It's going to be there. Regardless of if you're dropping or not, you're still going to have value in that spread because it's at the money. Now, of course, if it goes the other way or it stays flat and you're out of the money at that point, the contract's not going to have any real value built in. So it's pretty much at that point the same loss that you're going to inquire with just doing naked contracts. Now, if we're talking about calendar spreads, which will be a little later in more detail, but at the moment, pretty much in this example, had I bought and sold calls on Netflix, and particularly for, at this point, I'm running the best expirations seem to be right around a month to roughly 2 months. And had I bought it for, say, because I could have been much closer to the money, so expiring at 530, I could have sold the contract for 530, 540, and bought like a 515, 520 for much further out, probably in September or so, and I would have had a huge profit return immediately on that sold short contract because, I mean, look how low Netflix went. So the moment this next day opened, that contract would have dropped hugely in value. And even when it came back here, I still could have bought it much cheaper. But at this point, the contract's just growing worthless and worthless and worthless up to the point of expiration for the short. So the long is what you need to build the value. So way over here, when Netflix finally broke that position, it just started breaking out. And we got all the way. I mean, look at this. You went from the low at 490, closed at 490, and opened the next day and just blew the roof off. Got all the way up to 524. Next day, you're hitting 540. Oh, I'm sorry, the same day. That's the same day. 548. So right there, had I initially bought, look at the date, August 26th. Had I bought the initial contract expiration that I wanted at September 4th, but I chose because I had a lot of faith in Netflix due to Corona, that they were going to have tremendous revenue and all this stuff. But all it took was them saying that the earnings missed a little bit, and then the outlook was unclear, and it just destroy the earnings as a whole. So those things you got to keep that stuff in mind, because in all reality, if you're playing earnings, you're just gambling. Let's be real, because there is very very few situations to where you can actually go into earnings and have a really strong opinion that you're going to be right. Okay, because you can very simply be right about the direction, but maybe it doesn't move that far. And if you went ahead and bought lotto contracts, even if they're only $10, $15 each, say you bought 10 or 20 of them, but they go to like $2 the next day, you just literally threw away money. You're better off if you're doing that. You might as well just go to the spots and scratch offs at the gas station. Let's be real. If you want to trade smart, we'll talk a little more in detail on the debit and counter spreads. So let's hit on back to the. Does that? I mean, I know I explained a lot there, but hopefully that kind of answered that question.
Yeah, that covered pretty much all of it. That was great.
Okay, yeah, I know it was a lot of information, and a lot of other people, I won't mention any names, of course, but a lot of other people really focus on credit spreads, because if it's under this price, it's guaranteed to be in the money and blah, blah, blah. But what they don't tell you, and what most of them don't teach you, is that whatever your collateral is, say the trade is a $500 spread and you receive a $100 credit, you're actually risking $400 on that trade. The collateral, that $400 cash that's being held, is your risk. If you are wrong at expiration and it just goes completely against you, and this can even happen after hours, you will risk that $400. It's not like, buying a naked contract, $400, it goes down 5-10%, you cut your losses. Once that collateral starts getting locked up harder and harder, now you have to buy the position back. And obviously it's going to be more expensive. But in the event that it goes completely against you on a mere $100 profit that you could have made, you're going to lose $400. So vice versa with the debit spread, you would have paid $400 to make $100. But in that example, you can easily just close the debit spread, assuming what stock it's on, of course, because the bid-ask spread and the implied volatility heavily affect spreads as a whole, just in general, whether it's credit, debit, calendar, condors, any kind of stuff like that. The bid-ask spread, depending on the stock, is hugely impactful to the actual prices of the options. So just keep that in mind. Don't think that credit spreads, because when I first looked into credit spreads, I think January 2018-ish, I was watching some YouTube videos, of course, and there's this one cat just swore by, credit spreads. Like, and he did really well at first. It was like $5,000, and then he got to $10,000, and then he got to $22,000, and then I think he got knocked down back to like 13. So he lost a whole bunch, like right off the rip, thinking that these positions were just perfect, like God's gift to, to options traders as a whole. And my first experience with them, when I hit that Boeing, it was like a $1,500 profit. I was like, man, this is crazy. And so I went deeper and deeper and deeper into credit spreads, and sure enough, finally took a huge risk on Tesla. It was $7,000 in collateral for a mere, I think it was like $980 potential profit. My contract long this was after the split, so it already had ran up. I'm sorry, this is prior to the split, after the announcement of the split. It already ran up to, I think it was like 2050-ish area, and then it dropped all the way back down to 1850, and then it settled at like 1880. It set at 1880 for a whole day and a half, and I was like, okay, this could be a perfect scenario here. So I went ahead and added the credit spread for the bull put spread bear call spread. So 1990 to 2000 was my actual spread. Well, I was up nice profit. I was going to close it that Thursday, and I was like, you know what? Let me just add some more. So I added more. So now I'm risking $1,000 spread. I'm risking, $900 and something per contract. And I can't remember how many I bought. It wasn't that many, but it was enough to risk $7,000 in collateral. And sure enough, Tesla blew up that night. Midday, it ran $130. Got all the way up to the 1900 something range. Turned around and ran up more after hours. Pre-market 4 a.m. open, gapped up to 2050, and I only salvaged $500 out of that entire position. And something like that, because I see a lot of people trading credit spreads on Tesla, and I've had people message me wondering how they lost $20,000. One guy lost $40,000, and a handful of other folks lost $500,000 here and there. And if you don't understand the trade, that's why I teach this class, because I want you to understand the trade. If you don't understand the trade, even after this class, you can message me and I'll make sure that you understand, because any signal I put out, I'm expecting the people that took my class or read my books or me and Sniper's book or whichever to understand what it is that you're actually trading. And if you don't, I want to make sure that you do. That's my responsibility for this whole Armor Bull trading in the first place. And that's why I have my YouTube channel that I started a few years ago to actually teach how to trade. You know what I mean? Because when you follow signals blindly, let's be real, you're hoping that those people are right. Now, somebody like Kevin TCX, obviously, he's really good at trading his way. Now, can other people translate his same trading? That I'm not sure. I know a handful do, but once you learn how to trade in general, you're sort of trading on your own. You're not really just copying signals. But for the tons of folks I see in his group and many other groups, actually, I'm part of quite a few chats, they all actually will have just straight up buy signals, straight up sell signals, but they don't tell you when to get in the trade, when to get out of the trade. It's like, I mean, I'm gonna be real with you. Anybody can say, like right here, like a matter of fact, I think Sniper's actually in this chat right now. I think we were talking about Boeing just the other day. I saw it pushing on the band. I think she was sitting, I think it was actually this candle. Yeah, so right here. So it was like 239, 240. I was like, man, if it breaks 245, it's probably going to go ahead and break out the rest of the way. Now, clearly, I didn't expect this because I would have certainly called that out. But I figured we were going to have a double top. You know, that's why you see my circle here. But it just clearly broke clean out of this area, and it was tremendous. You know, some people got it, some didn't. But for the people that figured they were buying puts here, if you bought naked puts on Boeing, Boeing's not cheap anyway. And you can see that she's getting pretty overextended at this moment. So way out of the Bollinger Bands, which we will talk about in a little bit. It's a beautiful trade. But here's the cool thing. Had you taken call counter spreads on this money, I actually opened up two sets in the chat. I don't know if any of you guys took those signals. I got the one. Let's see. Let me close this real quick. Let's see. So I got this one here. Looking at buying the 285 for April 16th and selling the 290 for.
I can't listen to you, and you're sitting there microphone in the joint.
Do it now. Hello?
I think he was talking to someone in his house or something. I don't know.
Oh, okay. Yeah, I don't know what that was about. Okay. Yeah, definitely not smoking any joints here. Anyway, back to it. Now that I have a problem with that, I just don't. So anyway, so as you can see here, so this is a calendar. I know we're talking about debit. I'm kind of jumping around a little bit, but each thing I'm explaining has a direct purpose on this. So going into this here, so I bought the 285 call because I'm still very bullish, right? But look at how much this credit is for the 290 sold for April 9th. I still have time for Boeing to retract. And if it retracts, this 740 is going to disappear so fast, and I'll buy it back much cheaper, right? In the event that Boeing continues to run, it can go all the way to 290. And guess what? I don't care. I don't care that it stays at 290. It can actually go to 300, and that's fine with me. Because if it does, I'm still going to have that risk factor on my side because my long 285 call is going to be hugely up in the money, right? And then the 290, that's why I built it separate like this. So with 290 that I sold for April 9th, it must be above 290 for this to be worth anything at all. If it expires at 289.99, I collected this full $740 premium. That credited to the 285, so I actually discounted my trade as a whole. So when you look at the reality of this, it actually costs $992. All right, so let's go back to the other. Here's the 740. So officially, I got a credit of 715. All right, so it's at 740 right now. That's because it's going up in value. But once the expiration starts to bleed in, right, and we get really low on that expiration time, say 2 weeks, a week, or whatever, it's going to rapidly dissolve. Boeing has a lot of theta, and for me, that's great because let's see, yeah, you're looking at roughly on this contract. It's not terrible because it's pretty far out of the money at the moment. But once it starts beating into that contract in that last probably 2 weeks, this theta is going to step up big time, and it's going to pretty much make this contract just disappear. And if you,
I have a question.
Yeah, go ahead.
What's your risk to reward ratio, like minimum you want to have in a trade.
You talking about opening up a trade in general?
Yeah, like for any debit spread. I mean, are you looking at a 50-50 at most? I mean, obviously you want to make, the most for your buck, but I mean, what's the highest you'll go up to?
Yeah, so going for debit spreads, I really love to build. Give me a stock. We'll make one right now. Any stock you guys want.
Netflix.
Upgraded my internet back to much higher, so Robinhood actually participates when I do Zoom now. All right, so let's say first let's appeal to the chart a little bit, see what kind of range we want to see. All right, so clearly on a slight downtrend here. Let's look at the daily. Let me get back out. There we go. All right. That's a huge gap that got filled. All right. So 492, we're 517 after hours. Okay, so we're looking like we got some support going on. So we need to break over this EMA here. This is the 50 EMA. We need to break over. That's 530, so it's $15 move. So what we could probably do would be, or what I would do in this scenario, I would go further expiration. So with debit spreads, you still want to use expiration to help protect you. Counter spreads is slightly different just because you really want theta to eat the other contract so you can get rid of it. Because if the move happens, midway through, your long contract still can build a lot of value. So let's see, April, that's one. So we'll go April 30. Seems like a pretty decent time. That's a little over a month. Let's see, 530 is what our EMA is at. So let's go with, just to see what this ratio comes up to be. So this is a $250 spread. All right, so this is going to be, roughly a 1-to-1. It's not going to be much higher than that. So it's $250 spread. You're paying $123, and this is aftermarket. So these contract premiums could be slightly different when the market actually opens. So what you want to do is actually go this route. So now you're looking at a literally roughly 1-to-1, little $20 difference there on the 250. But so you're looking at a $500 spread. Okay, and again, how we do that is basically subtract. So 530, 525, it's clear to $5. Multiply by your 100 share multiplier there, so you know that that's worth $500 as a whole. That is the max value of this debit spread. Period. It cannot be higher than 500. It might show you, at 600 or 700 or it was 900 or something like that, but just know that you cannot sell it, and it will never ever be worth more than $500. So if you pay 228, or say you get in a little less than that or a little more, you're going to have roughly a 1-to-1 ratio, and that is the minimum that you want, right? So if this spread, if I went down here, I personally prefer, it kind of shows you normal 1-to-1. I really prefer seeing 2-to-1 or 3-to-1. All you have to do for that is literally just change around the contracts. So if you expected a slightly higher move, you could probably swing something like, I wouldn't expect Netflix to get too crazy. Let's be real. Let's see, that's still two. Yeah, but Netflix is still kind of moving a lot right now, so you're not going to have the best spreads, especially not with really high probabilities at the moment because the direction is still kind of undefined. Let's do this route. All right. I get a slightly better entry, still $500 spread. So at this point, now you're looking at having, see the bid ask here, 0 to 360. Clearly the bid is not 0. There's just no entries of price right now. So you really have to wait for the market to open to see an accurate price depiction on this. So 178 may or may not be accurate. So if the bid comes up to say 250, then you know you're going to be a lot closer in between here. And or if it drops down from 360 to say 290, and then the upper side here is like 190, you know you're going to be somewhere in that range. So always mind contracts during market hours. Try not to look at them after hours. You can kind of see what it's going to be guesstimating, but if the premiums flip on you at the end of the day, I know a lot of people see that a lot of times on debit spreads with long expirations. You'll have one contract that goes to like, it glitches, whether it's Robinhood or TD or whoever, it'll glitch and say, $5 when in reality the value is actually like $225 or something like that, but it's showing you the incorrect value there. So you can't really depend on the aftermarket prices. wait until the market opens or right before the market closes if you're looking at getting into any positions like that, so you can be very clear what the actual cost is. Real quick, if you're buying contracts with a bid ask that's this wide, clearly it's not going to be this wide, but let's, we'll just say for easy sake 300 to 360, and say it shows 325 here. So I may or may not be able to get in at 325, but if I know that they're asking 360, I could probably say 350. I'm going to try that. If it fills automatically, then I know I got in. Otherwise, I might have to go at the ask. Okay. And if I hit 360, there's a huge chance that yes, I could pay 360, or it could actually drop down even further than that. And many, 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 many times, even on Robinhood, I get filled way better than this. So if the bid ask is 300, 360, I put 360, it might fill at 305. It might fill at 310, 315, etc. So that happens very often. So keep that in mind. But with this scenario, you are looking at a lot better ratio. So $500 spread for less than $200 at this point. So you're getting closer to that 2-to-1 area, but still not quite there on this, just because it's so out of the money. If you go further out of the money, yeah, you can easily get huge spread increase factor, but it's going to cost you risk more than anything, because how probable is it that Netflix goes to 570 or 575? Does that make sense? I know I might be kind of talking fast, so just let me know if it's making sense or not.
Yep. Yeah, it makes sense.
Okay, so ideally, to answer your question, it's simple. I'm looking for 2-to-1 at least. 1-to-1 is fine. 250 out of a $500 spread, I'm okay with that. If I know or have a very strong inclination that I'm going to be correct. So once we break 530 here, EMAs will cross over again. We can see that these ranges are pretty decent on resistance. So 555 to 565, and you can build the spread as wide as you want, but it's just going to cost you more on that short leg. Or I'm sorry, credit you less on the short leg. So let's put more faith in Netflix here. And let's sell, because we know that 575 was a hard resistance. So let's sell that, but we're going to buy a 550. So it's $2,500 spread, but it's going to cost you, $750 to get in. And with that being said, there's a huge probability that 550 might hit. Okay, and then once that gets in the money or near the money, and we're only going from 518 to 550, that's a pretty easy move for Netflix to do in that long term, where it's about 2 months there. And with that being said, I'm risking 750 up front. Now, the good news is, the closer it gets to expiration and that 575 starts depleting, my profit gets a little more certain. But really, you need 550 to be clearly in the money. And at this moment, say it's maybe right at the 1st of May, first week of May, I would want to see at least 565 to 570 on Netflix for this position actually to grow value and be anywhere near $2,500. So with that being said, you can actually get a little better. And this is what I was talking about with credit spreads. So just say you could almost guarantee Netflix will be in the money here, right? And with that being said, you're still getting a super great discounted rate. I'm going to project this is actually probably $250 instead of $220, $217, just because the market's closed. So say you pay $250 for this. As soon as Netflix breaks 535, this position is going to have a lot of value on it, and you're going to go from 217 to probably like 375, 400. And it'll kind of stay around there as long as Netflix stays inching up. And once it's over 525, you know that you're in the money. So the closer it gets to expiration, the more solid that value that you see will be. So if it stays flat right now and just trades at 518 for the next 2 weeks, this price that you see, assuming that was correct, would slowly just decline, because it's a less probability that it's going to be in the money. But now, if it's up here in the 560 range, and you have the 525 or 520 to 525, it's clearly in the money. And as that expiration grows more near, you're going to see the value just pretty much stay where it's at. It's not going to keep declining and jumping, unless Netflix is literally doing that every single market day. If it's jumping $10, $15 one way and then vice versa, yes, it's going to put a little more strain on the spread as a whole, just because you're going to see this huge bid ask constantly fluctuate. But the easiest way to think about debit spreads in general is probability. Okay, so if right now is March 14th, we're going April 1st. Let's still put some probability factor. Okay, I feel like Netflix can definitely be above 520 at expiration. Let's go ahead and close these. Sorry, get those out of there. So now you see, but look at the May contracts. The May contracts were costing the same thing, right? However, my probability was slightly different. I'm already in the money on this 515 contract, and then I can easily be in the money on the 520. So if I open this 260 and I paid that, and I'm looking at, say, a 530 price target, the moment I see this spread hit $350, I'm probably just going to close it because I already made $100 roughly, $90 or whatever. That's plenty of profit for that spread. Of course, I can hold it longer and I can risk, going out to April 1st, which you got that solid 2 weeks and a half that you're going to get to. And the probability has to stay there. Okay. So if Netflix stays flat, it's going to be okay as long as it doesn't trickle back down too much to 515. Now, if it gets to 525, 530, as our EMA shows us, then we're going to be a whole lot better on this position. Say it's at 530 on, say, Monday the 29th there, right here, we only have a few days left to expiration. We are solid, so that position probably would be worth around 430-ish at that point, to build maybe that roughly last little bit of money into it on the expiration date. Because, of course, anything can happen. This is the stock market. And probability factor tells us that the closer it is in the money, the better you are. So keep that in mind when it comes to building any spread. But in general, debit spreads, that is the thing I've learned that works the best, is putting the probability in your favor as best you can. So if this position cost me 260, yes, it may build a little more value quicker if Netflix continues bullish. But at the same time, if I'm expecting it to go to 530 and I'm setting myself up with a 2.5 week expiration, these 655s, they're kind of tempting. Obviously, it's a lot more money, but at the same time, the 550 area, would probably be, this contract can easily gain 30 to 50 or 60% just on a move from 518 to 530. Probably more than that in the same day if momentum really kicks in. And because if you've watched options contracts for any amount of time, you'll know that once a move starts, like SPY or Boeing or whatever, you can see contracts go from dirt cheap to really expensive, easily 10 times the value, very, very quickly. And you want to think about the same thing when it comes to building spreads. So you want to see the contract build, but if I can pay, 250 or 220 for a contract set in May, why in the world would I do it for April 1st? You know what I mean? And we're talking about the middle of May too, not just May in general. So I would have a lot more expiration going on there. And that's the thing that I try to teach the most, is expiration time is your friend, especially when it comes to, let's pull up, let's say SPY. Now SPY is very erratic, but their spreads are great. So you're going to see the bid-ask difference here. Hopefully we get a good spread. Let's hit up same thing. Let's go April 1st. Let's see. Market movers really don't want her to hit 400 anytime soon, it looks like. But with this whole stimulus package passing, I think we have a good probability to get there. Let's go with, let's do 395 to 400. So still, you get a $500 spread, but we need to get closer to $400 for this to actually make sense. So it's going to cost you $200, and your spread. Look how close the spread is here. And this is probably pretty accurate on SPY because SPY is traded constantly at rapid, super high volume. So you're talking about like a $7, $8 difference here on the price of the spread versus, so 213, 215. At this point, am I really, if I'm expecting to make double of what I pay here, so assuming that we can see there's a high probability this SPY could get very near $400, say I'm buying at 213, 215, do I really care about this other few dollars, right? And that is called slippage, and it's going to happen in any case. If you get charged fees, or if you always have to get the ask price, then yes, you are technically losing money to slippage. When it comes to limits, easily. Put your limit at 205 or 200 if you don't want to pay 213 or 215, and then don't worry about it. But what you have to worry about now, if you put your limit order in and it doesn't hit, then say SPY jumps to 398, well, you just missed your opportunity. Now, are you going to get FOMO and try to come over here at the last minute and get a call contract and maybe catch a little profit move? Or now you buying a spread up here at 398 to 400 or 400 to 405, expecting the price to continue to push, and the turnaround just reverses. Say it drops back to like 396, 397. Now you just wasted time and money. Okay. Does that make sense? Everybody still with me?
Yes.
I know it's a lot, guys. I really do. and we'll build some more, later. And this is what I want to do more is show you how to actually put them together on. Robinhood is the easiest, of course. I don't really trade with TD Ameritrade. I use Fidelity, but when I'm trading these spreads like this, it's just so much easier to do on Robinhood. Let's see. So same spreads. Let me close these out. So we're in May now. Let's sell the 400. I mean, you see how these contracts are way more expensive. But look at your spread cost. It only went up $50. So for $50 more, you can get a May expiration, have tons of time. You literally could not even have to look at this trade pretty much at all because you got a lot more expiration time. As soon as you start realizing profit, or you can set you a sell limit at say 350 and just let it ride. If SPY jumps up to 398 or so, it's going to rapidly build that value into the contracts because at the money is getting very, very close. So once it breaks 400 and it's say the end of April, you're going to be looking at a pretty good build of price on here. So probably closer to 390 to 415 as far as the total value goes. And I'm quoting those numbers because I've traded so many debit spreads at this point. I can kind of project the values because even on the very last day, even if there's 10 minutes to market close, it could be $2 in the money and it's still not going to show you the full value of the spread. You still might have to sell it at say 495 total value or 490 just to get out of it. Because again, yes, you could sell it or you could let it expire, accept your full, technically $500 a total value, or maybe SPY reverses or you get exercised after hours. Now you have to worry about that. But if you close the contract expecting, another $3 or $4 or $5 gain, do you really want to risk making your $150 profit here for another $4 or $5? Does that make sense? Because I have a lot of people ask about contracts expiring and should I let them expire? What's the best way to trade debit spreads when it comes to, letting them expire or not expire? I heard you're always going to get assigned on shares, if it's in the money, or if it's even going to expire out of the money, and that's just simply not true. So I'm not saying you'll never ever get assigned, but if you do, that's what the other contract is for. That's why spreads, generally debit spreads, are very, very low risk items to trade. You cannot trade these on cash accounts, by the way. You have to have margin or Robinhood Instant or whatever margin on any other brokers that you use. And I think TD Ameritrade is a $2,000 minimum. Webull is probably also a $2,000 minimum on their margin. And Fidelity, I think, when you trade more advanced strategies, and depending on how big of a spread it is and what share price it is, I think their minimum is 10,000. So those things you got to keep in mind too. But again, Robinhood has the instant. It's free to trade. You're not losing any money unless you're just trading bad. So when it comes to sampling spreads, if you want to sample debit spreads and how they work, this is the best stock to do it on right here. Ford Motor Company I actually traded Ford and GE only when I first started trading it in late 2017 and 2018. I only traded strangles on them, sometimes naked positions, but only traded strangles. And we'll talk a little more about strangles later. But to quickly just kind of talk about this here that you see, look at the deltas. So this is a 319 on a 14, 65 cents out of the money. But you're looking at a 30 delta almost, 27 delta, plus the gamma is super high. So you're going to add a lot of value to this contract rapidly if Ford continues to push up. I haven't seen Ford at $14 in a long time. It's been a couple of years, I believe. So, I mean, looking at a 27 delta right there near the money. But all it has to do, say this goes to like 1390, the $114 call would actually gain a lot of value pretty rapidly. Y'all still following?
Yeah, I got you, bro.
Okay.
Yeah.
No worries. I mean, it's going to be recorded, so if anybody's listening, not listening, fell asleep, I mean, it is what it is. You know what I mean? I told you guys I'm going to do the class. I'm doing the class. So some of this information is tough to take in because it's kind of hard to examine all these different types of spreads. What I will say is I've personally traded tons and tons of debit spreads. Like I said earlier, clearly over 1,000, and just looking at my trade history, and debit spreads work better than naked positions majority of the time. If you're looking for very quick profit, then of course naked is going to turn out a faster percentage ratio as a whole, just because it's a naked contract, right? So the probability hits, the Greeks start to happen. You get your gamma, the vega impacts the IV. You got all these different things occurring, and the contract will build up rapidly. So say you bought a naked call right here at the open at 1288. Say you bought it at the money, 1250 or $13, and it shoots up to 1335 midday, 1340. You would have made a pretty fat return on forward contracts, and they're super cheap. I mean, look how cheap this is for 4 days. Well, that's expiring early, but say the 326 is still only $45, and it's almost in the money now. So with these contracts, you can build very rapidly when it comes to forward. So let's say we're bullish. Let's say we can almost be certain that a few days from now we're going to be above $11. But watch how this changes as a whole. You can see how close the spread is. So it's a $50 spread, 11 to 11.50. It's $46, right? So you're actually paying. Hopefully, you can get it a little cheaper. Closer to 40, 35, something like that. If you're lucky, if it drops a little bit. But for this spread that expires in 4 days, you're going to be able to get in this contract and guarantee your money. If you set up a credit spread, matter of fact, okay, so look at this. So one is going to run you at the moment $46. Let's build a credit spread and just show the difference, just so you guys can see that I'm not just feeding you a bunch of crap. All right, so we're going to we did 1150. All right, so put credit spread. You're going to want for to stay above that area, so it's going to give you roughly a $1 credit. So with the other position that you just saw, the debit spread is actually going to be very similar to this, but as you saw, the bid ask price, the high side on the ask was 54, so they're subtracting a lot of value there. But you can see how close they are as a whole. So you're risking basically $49 to make $1 in this scenario. So in the event that Ford dropped back down to, let's say, 1099, somehow something happens, whatever the case, you'll lose the whole $49 to make $1. And even if it was 45 to 5, you're risking $45 to make $5. You know what I mean? But the issue is, if it does do that on a credit spread, it's going to hold your premium, and that negative contract offset, you're going to have to wait until expiration to be able to get back to a good position, because you're going to get assigned, you're going to have to exercise the other contract, and it's going to wash completely to zero. So now your entire collateral is at risk. Whereas in a debit spread, okay, Ford moved against me. My spread went from $45 to $37 or $36 or even $30. You still salvaged all that money right then and there. You cut your losses, you're done, you're out. With a credit spread, you can't do that. You have to buy the current position back, which would be, in this case, it could jump up to like $10, $20, $30, $40, $50 real quick. And then at that point, you have to pay that to close the position as a whole. So I'm not playing with you guys about credit spreads. Trade them at your own risk. I do not teach credit spreads. I don't like credit spreads, and I traded them for roughly about 6-7 months. And I had a few good experiences and a few bad experiences. So it kind of equaled out as a whole. I definitely lost more than I made, but for a minute there, it was pretty consistent. And I was looking at, okay, so Boeing, and I hit Netflix, and I did Boeing again, and I was making decent little consistent money. And then all of a sudden, Tesla hits. So it just watched any of the gains that happened was completely a waste of time. But I don't teach anything without doing it myself in real life, trading my own money to show that, okay, in these scenarios, such as earnings, like you guys asked earlier, that it can actually either A, be good, or B, it sucks. So for me, in my opinion, I think credit spreads suck. I think they have value that can be used in certain situations. But when it comes to risk reward, there's literally no reason to trade a credit spread over a debit spread. So now we're going to jump back over. Don't know who's messaging. And let's see. Let's head back to our actual presentation here. So hopefully you guys all read this here. So SPY decreases the price, election November 2nd. Basically, I was hoping at that point, because anything's guaranteed or not guaranteed in the stock market. So you have the probability that, okay, if Biden got elected, and I projected that he would, in my own opinion. Of course, I'm not a politician or anything, but I had a very strong feeling that Trump was not going to get reelected. I didn't vote for either president, so I have no political impact opinions on anyone who voted anyway. But what I was expecting was the market to actually reverse. And Trump even said it himself. He's like, "Oh, the stock market's going to crash if Biden gets elected." Well, currently that hasn't happened. We're still pushing all-time highs. The Dow Jones hit all-time highs like 3 days in a row this past week, and it's pretty awesome. I'm not saying we're not going to have some sort of maybe 5 to 15% pullback again at some point, once the stimulus hold passes around. But at the same time, in this scenario, I was expecting the market to probably dip around like 300-ish, somewhere in there. If you look at the last example that we looked at, you were looking at 338 roughly was the stock price. Here you're looking at 327. So you see that $10 drop only gave me a few more dollars on these spreads because they're so far out of the money. Had I been at the money, of course I would have paid a lot more for it. But I was looking at essentially a lotto to hedge all the bullish positions that I was in at the time. It'd be wise for me to close around the implied volatility, highs, and I didn't do that. I held, and essentially it was over $1,000 at one point, and I should have closed it. I easily could have got out at $5 to $6 a contract set, and I would have made a pretty decent amount of little cash there. But at that point, the expiration was I still had some time, and anything could happen. But again, it was a hedge. I think the total position was worth around $750, and I walked away with maybe $25 on the total. But at the same time, I was making money on all the bullish positions I was in and swinging those. Again, this was ultimately just a hedge on the possibility that the market, ultimately speculation, was possibility that the market was going to dip hard, with the Democrats winning the election. Moving on here. So we just built some debit spreads for you guys, but these are other examples showing you the spread widths. So in this scenario, it's called debit spread in the money. Okay, so again, this is why would you trade credit spreads if you can trade debit spreads the same way? So it's in the money. Okay, we're not expecting Apple to go under 114 anymore, or 113 even for that matter. So we're going to look at 110 and 112 at expiration. The price is going to be even if it's at 114, 115, we're still in the money. So it's just going to have that value sitting there, and it's going to slowly increase as expiration gets closer, because your probability of staying in the money and those contracts expiring in the money at expiration is just getting better and better and better. So expiration change, the value of the debit spread you pay, increasing or decreasing your max realizable profit. And realizable profit, again, is the difference between the actual spread width. So in this scenario, 110 to 112, it's $2, so $200. Our actual profit would only be $75 because we're paying $125. Does that make sense? I need to get a comedian.
That makes sense.
I need to get a comedian. I need to get a comedian on here to talking to you guys. All right.
I had to break the silence.
Yeah, no worries. All right, put debit spread in the money. Literally the exact opposite. Again, this is very, very similar to doing credit spread opposite, right? So in the credit spread, you're doing the exact opposite. You're doing a bear call spread at 120 to 118. But in this scenario, you can see that the debit spread is giving you a very clear definition of what you're doing. Okay, we're certain that Apple is going to stay under 120 and 118, so we're going to go ahead and do 120, sell the 118, and it's going to cost us 143. All it has to do is stay under 118. Once expiration gets closer and closer and closer, it's going to just slowly build that value. Now, for this scenario, it's only 200. So with something like this, I would only expect to make $20 to $30 on the spread. If you have 10 of them, obviously you multiply that, and a lot of times I do a 3-contract rule. When it comes to cheap spreads, if they're like $100 or something like that, I may add 5 or 10 of them at the time, just to quickly, fold. If the contract moves $10, but I bought 5 or 10 of them, I just multiply that and I take my profit quickly, right? I'm not going to just sit on, $143 spread, hoping I make another, $57, because if I make another 30, okay, cool. That's great. I'm going to close the trade. I'm going to move on. I'm going to let my money use somewhere else. There are some times where, you sell early and take a profit. The stock blows up, and makes more money. But look at the reality factor. Okay, so say Apple did, stay down, drop further, or whatever. You closed it at 180 in this scenario. You still made, $37. But at the same time, you didn't continue to risk that money. And of course, you didn't know what Apple was going to do. If Apple goes over 120, you lose the whole 143. So with those things, you got to keep that in mind. All right. Again, will you get exercise on debit spreads? Very low risk. Very likely not. If you constantly let them expire in the money, there's somebody out there that, or whatever fund or whoever actually has your sold contract, there's a potential to get assigned. That's probably one of the reasons I've never been assigned, because I never really let them expire. I've had plenty of them expire in the money and at the money. And what you can see is essentially the residual value of the contract at expiration is what you actually get. So if it's under the sold contract, that's when it starts to kind of break the value down a little bit. So that's why I'm telling you that your actual value is the full distance between those. And if it expires above the one you sold for calls or below the one you sold for puts, then that's going to be your max value. I had one person during the whole GameStop and AMC thing. They had a debit spread and they sold a $4 AMC call. AMC shot to like whatever it was. I think it was like $10 at the time. So clearly they were going to get assigned, right? And they did get assigned. And I was like, all you got to do is exercise the contract. You're good. They still made profit. It wasn't a whole lot, compared to what they could have on a naked contract. But point was they were good. And so just know that no matter what the spreads are, your long contract always is the offset to your short. If they're the same strike price, you can pretty much write off any balance in between. If they are different strikes, so say you got a 300 and a 305, your long is going to outweigh the 305 and it's going to be worth more money. So you're going to, and that's how I built the counter spreads. And you're going to actually have all that value in there. That's why when it comes to doing the debit spreads, the same scenario. You're going to be buying the one that has more value and selling the one that you don't think is going to hit, and it's going to lose all of its value. But the good news is you already were credited for all of that sold position. So you don't really have to worry about it being assigned unless, again, it's really in the money. So then somebody's going to be like, yo, I want that contract for that price on these shares, because if I can get these AMC shares at $4 and they're at 10, I know I have these shares. If AMC does what GameStop did and it goes to 300, I'm going to make a ton of money on these shares, right? And that's the kind of behind the mirror scenario that's actually occurring. You don't really see a lot of that. It's more talked about than anything. It happens to people who trade really, really heavy positions more than not. People who trade in little tiny positions, a few $100s, a few $1,000s, those are not going to be things that people have to worry about being assigned. And again, when it comes to dividends, that is where you may or may not have a warning. So I think TD Ameritrade actually says, so-and-so stock has earnings coming up on this time. You have a risk of assignment. And that's basically just telling you that these people are willing to buy the shares, write off their loss with you so they can collect the dividends on the actual stock, especially if it's a few hundred shares. And of course, the dividend is going to outweigh, their small credit on the actual contract. So that's the chance that you may be assigned. But again, if you never let it expire, or if you go ahead and take profit when it's time, you don't really have to worry about that. Any questions? All good? The silence remains. You guys with me?
Yeah, man.
Yes.
Okay. All right. All right. Will you guys get exercise on credit spreads? Likely yes. Roughly, based on my experience, probably 40% chance. This is one of those scenarios I was kind of lingering towards earlier. I didn't really mention it. So the guy was basically going to get roughly $500 risk, but in this event, he got exercised. Or I'm sorry, I keep saying exercised. He got assigned after hours, and then he had some issue with getting the contract able to be exercised after hours with his brokerage or his phone or whatever the situation was. And his account had roughly 30 grand in it. And when the shares, I think actually it was on Tesla. So you guys can see this title. Feel free to go watch this video on YouTube. It's a pretty great video, actually. Just listening to the guy that was actually kind of, telling how it all happened. More than likely, he expected Tesla to stay in some area similar to what I did. For him, it actually didn't drop as bad as mine, but he still lost all that money because his account held X amount. So say it was 30 grand in this scenario. The shares on Tesla clearly were more money than what he had in there. So they took the entire $30,000 to cover, because he no longer has the right to exercise his contract that he bought for the long side, whether it was debit spread or whatever, credit spread. When the expiration is gone, you have no entitlement to the shares at that price. Therefore, you cannot exercise anything. So whether or not it was the brokerage's fault or if it was his fault, nobody knows. All you know is that he lost 30 grand. All he had to do was close the contracts. He was already at profit, but he was one of those folks that's like, nah, we're just going to let it expire. It's cool. Well, now he's 30 out, right? So he lost 30 grand to probably make another 15 or $20, on the contract. And I can't remember the exact scenario, why he couldn't do, why he couldn't close it or whatever. I think it was just that he was going to let it build the last little bit of profit in the actual credit spread. And then Tesla did what it does best, and it just moves crazy at random times, and it burned him. So here's the title for that video again. Feel free to look it up. I guess is the YouTube channel there. So moving on. Are debit spreads worth it? Simply, yes. They're a lot safer, more strategic. You can get in the money positions. And again, Amazon, you can get stuff like that. I'll show an example in just a second. So more strategic, you can match your price targets or ranges more closely to the trades in your account sizes. So again, on Netflix, we're projecting 530 at that resistance. We can build a spread in the money at 520 to 525 for, $250 and look at potentially making another $250. So essentially 100% return, doubling your money on a very, very, very possible move. Okay. So say, okay, I can get naked contracts, but I can only afford the 580s because it's $250. Say your account is down to that area. Well, for one, you're risking a moderate amount of your account probably if you can only afford to do like a $250 contract. So why in the world would you buy an out of the money contract that has a very low probability of hitting? Of course, Netflix moves kind of dramatically sometimes, but in all reality, is Netflix going to hit 580 anytime soon? Probably not. So with the debit spread, you can get at the money or even a little further away to lower your cost a little bit, but always monitor that expiration time, because those big moves, you will still get your profit on a contract that has 2 months expiration versus 1 week expiration. Yes, the 1 week, because the probability is higher, will gain more rapidly, but the longer expiration is going to build value more slowly, but it's going to it's still going to be there, right? So if it's if you're $10, $15 in the money at that point, that spread will be easily 60 to 70% of its max value, and you still have a month or so for it to occur. And at that point, guess what you can do? Say Tesla or whatever stock it is just keeps moving and moving and moving. It's just going to make your contract better and better and better. Because even with a 10% reduction on the stock price, guess what? Your contracts are probably still in the money. And as the expiration nears, your contract's going to slowly build more value. It might appear like it's losing value based on the slight price decline on the stock. But once that expiration gets closer, it's going to continue to get closer and closer to the max value of the spread. With debit spreads, you have known profit targets. You're capped, so you already know what you're looking for. I go for 20 to 50% on debit spreads when they cost around 30 to $100. Once it gets over that, your profit target should be lowered a little bit just to stay, kind of real about it. Stay in reality. Don't think that you're automatically going to make 70 or 100% return on every debit spread you open, because it's simply not true. It's very possible, if you get in the right trades, you're using technical analysis to promote a solid trade entry. You're not getting in at the high of day and then the stock drops, at the end of day. So you're going to lose IB on that. So always keep those things in mind. And real quick, trade in the money at a fraction of the cost. I'll show you a prime example of that in just a second. So use your technical analysis to predict your move on the stock price. Use debit spreads to match your prediction. Once you see your stock price target, whether up or down, make your spread based on 5%, 10% window. And what I mean by that, so take your example. I'll go ahead and read it out loud just so it kind of makes more sense. Feel free to read it yourself. So if you see stock, it's $100. We'll call it Halo. This was completely random. Going to 120. Base your spread on 10% max move of the target and the starting price. So look for your target. Calculate the time you need for the spread to make sense. So if it's going to take you 2 weeks, 6 weeks to actually see this price hit. Say if it's a slow moving stock, don't be expecting it to move $20 or $30 in 1 week. Of course, it can happen. Anything can happen, but it's not probable. So keep probability in your mind at any time you make a spread or take any trade for that matter, and keep that in mind. And it always helps you when it comes to taking profit. Okay, I think the stock's running out of steam, and it's okay if you take a profit. Guess what? You took a profit. Of course, you will always have stories about when Netflix or Boeing ran $75 more and you sold at $600 when you could have had 30,000. I have personally have like several stories like that, but I still made a profit on my trades. If you lose money on the trade, it kind of hurts your feelings a little more. But once you get past that barrier in your mind that, oh my God, I could have made this, I could have made this, I could have made this. Like my wife would tell me, like, okay, stop telling me what you almost made. What did you actually make? Well, I still make money. Well, there you go. Okay, great. So moving on. Look for your target. Build your spread for roughly a month. That's what I project to be the best expiration times is 1 to 4 months. There's not really a whole lot of point in getting expirations for 6 months, a year, things like that, unless you have a really strong inclination that the stock is going to get to some level that you're buying those options for. And not only that, but get enough of them to make sense. If you're buying one long contract that's costing you $2,000 and it goes in the money, say $10, $15, it's going to be worth more money, of course, but is it going to be worth that much more money, right? So if you're buying options at that point, I mean, say the $10 move happened in 3 months and you bought a 1-year expiration, you would have saved a whole lot of money. You probably could have bought more than one contract and compounded that money at a shorter term. So the thing that I preach the most, if you hear anything, build spreads right and always get expiration time. So back to this example. So Halo stock, $100, you're expecting 120. We go 10%. So $112 is your 10% ratio there. Build your spread to the max in this target area. This example, say we're bullish, of course, for calls. So you're going to buy the 112, sell the 120, create the call debit spread. And this width, you have $8, which is $800 in options. You'll assume the cost of $200 for easy math. Breaking this down, your max value, $800. Your max cost, $200. So clear definition right there. The most money you can make on this trade is $800. The most you're going to pay and the most you're going to lose potentially is $200. Very simple. And then this ratio is a really good return. So say, your max width, looking at 600 max realizable profit, close target should be $400 to $500, realizing a $200 to $300 profit in this scenario. So easily doubling your money, possibly more. Hammerroot, which is one of our Omega Legion members in Armor Bull, whilst we were going over doing his training 101, it was pretty great because we were constantly looking at these examples, and he made some tremendous returns doing debit spreads. I think he does like 10 contracts at a time, when he sees a very high probability trade, and he turned out some fat profit. Feel free to message him, and or tag him in the chat or whatever. He can definitely let you know, how he feels about debit spreads. All right, moving on. Pros of debit spreads: known risk, calculated position value, ability to be in the money, at the money, or get out of the money for micro positions like I did with the SPY. You can split the spreads. Now here's where it gets interesting. Diagonal calendar for profits. So if you're long the stock anyways, buy long at the money calls, and then you sell the earliest expiration a few clicks above at the money to collect constant premium as your other contract stays in value. And the cons is only really cap profit. When closing a call debit spread or put debit spread, hopefully got all you guys' attention because this is very important. You guys there? I think they all crashed on me and fell asleep. All right. So this is very important. So if you're watching the recording, make sure that you pay attention to this here. So when you're closing debit spreads or credit spreads, primarily debit spreads, we're going to focus on that. If you're closing a debit spread, so debit means you paid for it. So you're paying for the debit spread. You're obviously going to want to receive a credit getting your money from the trade. If you pick debit, you are literally forfeiting whatever value that is straight to the market and or Robinhood or whoever's collecting that money. If you pick debit, when you're closing a debit spread, you will lose all of the position's value. You're going to lose the money. When you're closing a debit spread, you select credit to close the trade because you're receiving money from the position, right? All right, moving on. Intentionally blank, have a glass of water. Matter of fact, I'm gonna get me a glass of water real quick. All right. Strangle straddles. Thank you for being you. Harmful Bull Trading. Here we go. All right, wet the whistle. So, real quick before I go into strangles, let me mention. Let's see what we got here. Got the chat here, just muted. No worries. Okay, cool. All right, let me go ahead and minimize this. Pop back over here, and just real quick, just so you guys know, you're looking at Amazon. All right, my price target on Amazon is pretty decent at this point. We've been looking for new highs for quite some time, and I think she's getting ready to do it. We have a clear, defined move here coming. So yes, EMAs did cross over, so you're looking at a potential bearish move. However, we pulled really, really hard off of the lower Bollinger Band, pushing back up, closed above this EMA here, heading back to the 50. You're looking at 31.42. All right, I'm going to show you a really great debit spread here. Feel free to... this is a trade that I would take myself, and I may do it. So I'm looking at this move occurring. Let's see. I don't like short weeks. It looks like that's a short week. So that's a Thursday. So that must mean the market's closed on that March 2nd. What is it? Good Friday or something? I don't even know. All right. So today's the 15th. So let's look for... I have pretty strong confidence in this. Let's keep it. Let's add some risk to this, and I'll show you the difference between the expiration times. So let's go for the 26th first, and then I'll show you the later date. So I'm pretty strongly thinking Amazon is going to move up here. And of course, it could be wrong. So the 500-hour spread is going to be 101, 260. Okay, you know what? I feel like we're going to pump back up to like 3,200. So let's go ahead. You can go in the money. All right, and it's going to run you 260. You're looking at doubling your money. Okay, very, very simple. Don't overthink this. It's not that difficult. So do I think it's going to come up here by that time? Probably not. Looking at 3087, probably a good spread to be. Good spread would probably be in this range here. So looking at selling 3170. So we're looking at gaining a $100 move. Hopefully it doesn't gap up in this scenario. So here's a $1,000 spread, so $660 potential profit if this is an accurate, spread cost. So that's a pretty wide spread on the bid ask, so you got to be careful with that. Also, don't get the term spread confused with bid ask spread. It's a very common misconception. So with this, look at that, $340, and you're getting a $100 move on Amazon, and it's going to rapidly build value at a max of $1,000. So 170 minus 160 is 10 times 100. $1,000. So you're going to pay roughly $340 for this trade. You can set a limit. So you're like, okay, so if the bid is 175, you know what? I want to pay like 295. Go ahead and put your limit. Preview order. Of course, I don't have enough buying power at the moment, so it's going to say you don't have enough buying power or whatever. So otherwise, it would say continue, confirm, and there you go. With that being said, now let's look at the longer expiration. So that was the 26th, and you saw about 260. Let's go ahead and hit May up. 3170, 3160. And look at that, $100 more, and you have a whole nother month of expiration time. And this is where it comes in. I'm sorry, 2 months actually. You have 2 more months of expiration time for just $100 more. If you look at the bid ask price, look how wide it is. So it's showing, I think it's what I just entered, so 295. So say in reality, if it's showing 460, you could probably get in this trade for maybe 355 if you're lucky, maybe 380. So put your limit in. If it's absolutely the most you want to pay for the trade, say, okay, I think Amazon's going to go bearish for just a minute, just long enough for me to get in this trade. Because you'd be surprised that the wide bid-ask moves, you can get filled pretty well. So always do limit order. Always make sure you select a limit order here. Put your own numbers in here, and you know for a fact it's a limit order. If you want the trade to run longer than just one day and maybe pick up next week or tomorrow, then set it good to cancel. That gives you 90 days. And the order will literally stay open for 90 days. If you forget you have an order open, then of course go to your orders, and then you can cancel it there. Now let's look at our at the money scenario we did. I think the first one was a 5 minute, $500. We don't have that option here because the contracts are more spread out. So let's stay at the money, and there you go. So you're looking at $510. So you doubled your value there at the money. But if you're pretty certain that you're going to get up into this other range of potentially close to $3,200, this is still $1,000 spread. So it's 1-to-1. It's a 1-to-1 ratio. So you're looking at paying $500 to walk away with $1,000. Okay, and that's just a way to look at it, right? So if you're going to take profit at 750 or 850, always think about those things as well. So it's pretty much just showing you that you don't have to spend. Because look at this. Let's be real. You want an at the money contract for May for Amazon? Who can tell me how much money this is? I don't know what's there. Hold on. Let me delete that. There we go. So that's $18,000 for one contract. So 180 times 10, or times 100, sorry. $18,000 for a contract at the money. Yes, of course. This contract's going to build insane delta and insane profit if it runs all the way to $3,200 because IV is going to go crazy. Your deltas are going to be building so hard, and it's per dollar move. So just look at the dramatic move that would be. So just say 100, it's $100. That's a lot of money, okay? It's $5,000. So potentially you could walk away with $27,000, give or take, on the high of day, and the implied volatility factor. So of course that's great, but do you have $18,000 in the account? Probably not. Okay, maybe you do. Maybe you have $100,000. But do you really want to spend $18,000 on one contract? Even though it is a May expiration, it does have a high probability, but you need to trade safe, and that's what I try to teach you how to do. Okay, so let's see, rational. Yeah, Amazon's not going anytime soon to $4,700, so that's not even in the question. That's how much you're paying for these debit spreads. Okay, but look how far they are away from the money. That's just unrealistic. So most people do this number here. They'll go March 19, so the earliest expiration. But look how far you're out of the money. But I see a lot of people do this all the time, especially in other chats and on Instagram and stuff like that. They'll spend 5 stacks on one contract, even though, yes, this has a very high probability of being, a profit maker. But if you're wrong, I mean, look at this theta. $530. It's just going to beat you down, and you're only making 50 for the deltas. So you definitely would have to hedge this position with something to make it make sense. But I was just showing you really that you can get at the money or in the money with Amazon. So continue on. Strangles, buying a call and a put at the same time, the same expiration. You can also change it to a calendar strangle using different expirations. So you can buy a call here, buy a put here, or vice versa. And again, this is buying a call and a put at the same time, same expiration. You can also change it to the calendar strangle using different expirations. Straddles, very similar to strangles, and I'll show you examples on Robinhood in a second here, except they're for the same strike on the same expiration. But again, you can turn it into a calendar straddle, and you can use different expiration times. But the strike must be the same to be a straddle. So in this scenario, if you have a pretty good inclination that it's going to go one way or the other pretty strongly, you're going to want to have some expiration time, though, because if you don't, implied volatility is going to break you on these two types of trades just the same as it can with naked and or debit spreads. Calendar spreads, not quite so much, which we're going to get to. What are strangles and straddles used for? Used for betting on both ways of the stock that you chose. So in the event that something like Amazon, Tesla, OCGN, Ocugen for the Covaxin vaccine they got, maybe they're going to blow up to $20, $30. Buying a high contract and a low contract is what you're looking for. So you got news, health trials, court hearings, mergers, stock buybacks, special dividends, stuff like that. you'll be in a position to benefit in either direction. But there's a catch, again, like I just said. So the catch is that these options, just like the naked ones, are affected by volatility, theta, and other Greeks. So if you try to use these options for earnings, you're probably going to get destroyed unless you have a huge move in one direction or the other. And because the one side of the contract is going to go worthless, of course, or lose a ton of value for IV, and with the other contract that actually outweighed it, moving a huge move. I've done this on Tesla. It was pretty great. I think I went from, it's like a 480% return. I closed it, so the position cost me, I think it was $200. It was on an earnings time, and then Tesla. This was one of the days when Tesla moved a lot in the early days. It was like $60 or $70, and it went in the money on me, and I made a nice 480% return. And then it turned and it kept going after that. So that actually got up to, I think it was about an 800% value when I calculated it down. So you can play both sides. Again, I used to trade strangles only when I first started trading back in 2017, 18, and I made constant 15 to like 40% returns just using Ford and GE. And I'll build some examples of that in just a minute. So you can cut the losing side loose. Of course, everybody asks this question. So of course you can sell one side of the contract. Like, so say whatever the scenario, whether it's earnings before or after, or before or after news. If you feel, okay, you know what, this news just popped, I feel like after hours or whenever this news hits, it's gonna blow up in my direction this way. Of course, you can go ahead and cut the other option loose. But if you wait until after the event, IV falls off, the premiums drop, and you're gonna lose that value. So what you can do is, it sounds complicated. You can cut the losing side loose, let the winning side run. You can allow the one side to continue running while still holding the other side, and close as a unit, such as how you opened it, right? So open it as one strangle or one straddle or whichever. You also can sell a call against the call you bought, or sell a put on the put that you bought to basically credit you back partial value that you lost on the opposed direction, or that you could potentially lose on the opposed direction, and then let it expire. Since you already received the credit when you sold the additional call or put at the same or different expiration, resulting in strangle straddle debit spreads, or strangle and straddle calendar spreads if you put it on different expirations. Okay, so keep those things in mind. You can always break a contract set down or build it together. So if you want to build together or leg together a straddle or strangle debit spread, essentially you already bought and sold. I'm sorry, you already bought a put and a call, right? So now you can just simply sell in either direction, essentially making more of a spread, similar to an iron condor or whatever. But something to remember is that we have a basic expiration idea for things like this. So if you buy too little time, again, like I said earlier, you're going to burn yourself. You need a minimum of around 2 months. This 1 month is good, but it's still short. So if you buy too little time, you'll only burn yourself. You need a minimum of 2 months expiration for these to be beneficial, and that's assuming that implied volatility is moderate or not too high. The issue is ultimately that without a direct move within 2 weeks of that 2 months, you're risking losing a lot of theta value as the last month becomes the primary time window to earn return. So like I said, that last like 2 to 3, 4 week roughly area, that's when theta really starts to turn the heat up and starts eating away at contracts. Even if you're near the money on those contracts, it can really start to break you down, especially on those big stocks with huge thetas. Now I will say that when I first started trading strangles again, I made a constant 10 to 40%, 15%, 40% returns. Strangles mostly. I was using simple formulas. Something I learned a long time ago in 2017 was 4 months was like your key window with low implied volatility, because you're buying these contracts. So you don't want to be buying strangles or straddles when the IV is very high. You want to be selling them or selling parts against them to make it actually worthwhile, because you're going to get credited that amount. So then if you're right, if you sold a good amount out of IV and you turn around and bought that contract back super cheap after the event or whichever, and or you can kind of let it run to expiration and expire worthless if you still have that time built in, especially with your long contract earning value as it's going in that direction. So you get the options the cheapest at these times for low IV and roughly 4 month expiration. Yes, you're paying a little more for time, but when the IV is low, there's no events occurring and things like that. Just quick note on a bear market, IV is often inflated, so keep that in mind. Of course, for a stock, so when GME shot up to $500, the IV just went crazy through the roof as contracts that used to not exist were trading for $3, $5, $6,000 each. Try to make both sides cost the same. This is big. So if one loses $5, the other can gain $5. So worst case scenario, you want to make $1 on the trade. You want to break even or get really close to it. This idea behind the straddle and strangle, because just always remember that your profit's based on your ability to efficiently build a position together. So again, things like expiration is huge. So real quick, I said I was going to build strangles and straddles here, using Ford as the prime example to show what I used to trade. So we can assume, based on Ford's move for the last week, she's up pretty decent here. She went from 8%. So let's see what the month is. Yeah, so 16.5, 17. Oh, wow, 46%. Wow, Ford is really pumping along. All right, let's see. So what I have currently built is a calendar spread. So I let the one, quick note, I let the calendar spread I had for the same $12 bought and sold. It actually completely was sold at 3 p.m. on this past Friday. So it didn't give me any additional credits, or, it didn't leave the other contract open. So with this set that I have right here at the 13.5 bought, so we're not at the money yet, but we're really close. It hit almost there. So I think it was here, it was 1340. Yeah, 1342. So that was pretty close. So $45 for this contract, and I sold the 14 for 319. So I'm looking at the 14 likely expiring, but I'm assuming that I'm going to be in the money on my 13.5. So if Ford continues to push, you're going to see a huge probability factor of, if 14 goes in the money, I really want to see what happens to these contracts. So if Robinhood just automatically sells it for you because you have your value built into the other contract that you bought, even though it's on a different expiration. Now, if it expires under 14, clearly this contract is going to expire worthless, and I'm going to earn that, whatever remaining value is on this contract. So I got 13. Right now it's at 16, so $3 loss on that contract. You don't look at it like that. You always look at it together as a set. If you build calendars separately, it's a little more interesting when it comes to seeing a huge profit, because you have to have the cash to close one side that you sold to close the bought side that you still have long. Keep that in mind. Real quick on these debit spreads. Here we go. So I would do something around this. So May. So we're going to go June. June is a good summertime expiration. And May go away. Always remember that. That is an old saying for investors and traders in general, for long term especially, because they know that summertime, people are on vacation. Nobody's actually trading the market as much as normal. Always keep those things in mind, because these little details can help save you money. So why would you buy, an expiration for, see, they don't even have May in here. So it may go away, right? So for Ford, they didn't even build the contract. And that's not specific to all stocks, but Ford's been around for a long time. So June or September would be your ideal. Obviously, September is a little further away, so you're looking at pretty decent sets here, though. Again, you always want the contracts to cost about the same. So say you're super bullish on Ford. Let's look at this 16. So 38 deltas, 45. I bet at the money's gonna be at 55. 52. Okay, so we'll do it this way. So we're going to buy this contract here for September 17th. So we got tons of expiration time. We're $176 for this $14 call for September. Okay, so what you want to see is you want to see return. Note, look at the gain. So if it needs to move 18% to break even on this contract, don't worry about that. Don't look at that. The percentage change of the option already had a 24% roughly gain on this time. So the low of day, find that. So the low is 143. So potentially, if Ford opens flat, maybe it doesn't really move, or it retracts back closer to 13, this $14 call is going to lose some value. Okay. Now the same can be said for the puts. So keep that in mind. We're going to build September, and then we're going to go back and build June and see what the difference is. Obviously, price will be a tad bit cheaper, but we'll find out in a second. All right, we're looking at the 14 at 176. So now we need to go to puts. Again, this is a strangle. So look at that. Perfect execution. And I'm going to be honest with you, this is actually a really, really good scenario, because Ford is at 1335. So it's about half in between each of these strikes. as far as a whole. So you're right at like midway point. So that's why these strikes are perfectly priced. So look at that, 176, 177. That is what you want ideally, because if this contract gains back any of the percentage that call side lost, you're gonna kind of keep your ratio there. Now, if Ford starts to push hard to the 16 level, it's going to slowly deplete this contract, but you're going to pump up more on this contract. And of course, you can always sell them separately because they are not bought and sold against each other. They are strictly bought contracts. So, do we want to build a strangle for $353, assuming that Ford will drop much further back below 13, so maybe 11, or if it's going to continue to push up even further? Let's find out. I'm going to go a little further on the risk factor here. So put wise, let's make it a little cheaper. Let's go with a 10 because Ford again in January was at 8. It's March. Let's do 11. Let's see, it'll be a little more expensive than the 60, but it's going to make more sense. All right, so we need to go to here. So that's going to give us 2, 3, and then 3. So technically this is the better way to build this. Because you kind of have an equal move on each side. Of course, you can lower your cost and get around the exact. I mean, look at this exact same cost. But the cool thing is, you kind of bullish on Ford right now as a whole, so you need to keep that in mind. I'm bullish on Ford at the moment. I'm not gonna. I wouldn't take this trade just because how much the call side earned. So if it went up 34% and the put side only lost 3%, that's not a very even trade. Okay. What I would do is wait until Ford kind of flatline for a few days to actually open a position like this. Now, the thing is, if it keeps pumping, there's not really a lot of purpose in waiting because then you're just going to miss your move. Now, the cool thing is, Ford is super cheap contracts. So if you expect Ford to go to $20, just buy the $53 naked. There's no reason to not. And you're still getting an almost $21 delta for every dollar move. So that's going to earn you a nice return there going up, from this $53. And say you bought 10 or 15 of those contracts, it's going to be a pretty decent return. And you have 17 Septembers to actually expire on that. Let's click over to June, and let's see what our examples could be around those same things. So let's try the 13 first. I'm going to buy a put for the same 13. So your costs are still pretty close. All right, you can see you're much cheaper. 335, I think it was, to 240. Pretty big cost difference there. And now let's tag out of the money a little bit. Let's go with, put side. Let's do 11 and call. We are looking at 17. So again, you want to make sure your cost is the same, because if one contract starts pushing really hard in one direction, say you bought it at 96 and your profit target is pretty low, say you're looking at like a 20% return, you're going to catch that pretty quick, right? As long as it's continuing to move in that direction, it's not like really slow. But here's how a strangle works the best, in my opinion, because you still have all this expiration time. At this point, you got about 3 months, right at about 3 months. It's still a pretty good expiration. So once it gets to the last 30 days to a month and a half, that's when it's going to start to kind of count against you more, because the contracts will slowly start to fade. But 20% on this contract should be very simple, okay? And all you have to do is it'll stay sideways for a minute. Contracts kind of level off. Maybe you average down, catch you a 85 or something like that, $70 entry, lower the average cost down a little bit. Let's say Ford pumps again, right? Say it pushes back up to like 16 and a half or $17 a share, and you're going to make a lot of money on this call. And then the put, you're not really worried about the put because the put's not going to lose much. I mean, look at this. This put only lost 16%, but this call gained 34%. So you can see right there, there's a clear difference. That's a 15% difference that you could make on that. Okay, and you need to keep that in mind, because that is what the target price is to earn a percentage return. Strangles, to me, work the best for this, and kind of small factor wise. The debit spreads can work in this situation as well, but strangle situation, I really enjoy strangles on Ford just because the deltas are so great. And when the price moves 50 cents on Ford, that's a huge move on the actual options. So that's enough about strangles. Now let's flip real quick. Straddle, same scenario. Again, straddles are the same strike price. So let's go 14. And then we're going to buy a put also at 14. Now look at your cost difference, right? So the $14 put is 178, whereas the $14 call is 116. So you lost 15% here. and you earned roughly 30% there. So it's about a half difference. So you need to keep that in mind. So you kind of want to monitor, what the stock is actually doing. But in this scenario, you're not going to want to buy, something crazy, because the higher you go in the money on a put, you're going to raise the value of it. So we go from 178 to 333 on a 16, but the call is going to be reduced drastically. Okay, so let's see which one kind of makes sense. So $300 for a $14 straddle, and or let's do, you're going to buy the 63. I'm sorry, the 16 for 63, and then 333. Yeah, so $400 there. That's I wouldn't really be aiming for something like that. So you straddle, just build it at the money, make it easier for yourself. In this scenario, at the money is kind of sort of both of these. So let's go ahead and buy the 13 put, and then we'll buy the 13 call. So you're looking at 285. So not a huge difference in price, but a little cheaper. Let's see. I'm saying that, but let me double check it again. Okay, yeah. So 295 versus 285. Yeah, so you're saving $10. So it's not really that big of a deal. The bid-ask spread on Ford is super good. 280, 290, very, very close. Straddles, they make sense, but then again, it is what it is. I prefer strangles over straddles, but the positions work very similarly, because one contract is losing value as the other one is gaining value, and you want the move on one side to outweigh the other. So when that contract value gets left in the past, it's okay, because the other contract is taking all that increase, whether it's delta, or delta and gamma impacting as well, especially something on earnings, heading up to earnings. Sorry, for earnings, probably don't want to be trading strangles or straddles, because you're gonna just, unless it really, really, really moves in one way, it's not gonna make any sense. So let's use Tesla as an example, and you'll see the price differences here on these contracts. All right, so she got back under 700. Okay, so we'll do the earliest expiration. So March 19. We'll do a 690 call and a 690 put. So you're telling me you're going to pay $5,500 for a strangle like this? Absolutely not. To me, so let's see, the 15th. So once the day before expiration here, or maybe the day of expiration, depending on if you're approved for that, and depending on if you have day trades available, because you will get hit with it, that's not going to be a good trade. So it's going to be, for one, it's just too much money. And Tesla would have to drastically move in one direction or the other to make an actual profit on that as a whole. My favorite, calendar spreads. I actually accidentally discovered that you could do these on Robinhood while I was teaching MRoot in the 101 back in November. And calendar spreads are the shiznit. All right, what is a calendar spread? Simply put, it's a modified debit spread. However, you're taking advantage of a larger possibility of profit. Why not trade calendar spreads instead, right? Because with that being said, the debit spread is max risk. It is max profit and max risk. So you know that whatever you pay is what you can lose, and whatever you see the spread difference is what you can make. Now, if any of you guys were in the chat when I did the CBS calls, calendar spreads, those were tremendous. We're talking $155 trade turned into $900 and something on the first time, and the second time even more. The same thing with Nokia, and it was a great all around situation. A majority of what I have open on Robinhood right now is calendar spreads, especially the Boeing positions. I'm really anxious to see how those turn out. And so far, Wayfair has been a huge moneymaker for me on calendar spreads. Simply put, modified debit spread, taking advantage of larger possibility of profit. And that is because you are on separate expiration dates, because your long position is still the beneficial part. All right, the sold you do want to expire worthless or dramatically reduce in value so you can buy it back much cheaper. So say you got, your long was $1,000, you were credited $500 for the short. You want $500 to fall off, because now you've just made $500 towards your long, in theory, discounting the long from 1,000 to 500. Okay, and that's the way you should look at that, in my opinion, because it's going to give you the best kind of understanding of calendar spreads and how they work. Now, if you have the same strike price, they're not going to be able to build as much profit as they would otherwise when they're separate strike prices. So say the Boeing I have, I think it's 285 to 290. That $5 window right there gives me a lot of difference potential when Boeing runs up. Okay, because I want Boeing to move. I want it to be a huge bullish position. But that's why I also bought the other side going down. So is Boeing going to be at that level anytime soon? Maybe, maybe not. I see 300 being the next target. Just be real with you. So knowing how to build these will be detrimental to your trading tool belt. And understand what it is that you need to build them. So the combination of both bought and sold calls if you're bullish, or likewise bought and sold puts if you're bearish. You must have a direction either up or down, or slightly up or down. A dramatically neutral target would be the way to say that probably. You need to opt for a good expiration set, not too close but not too far. You want a short call and put to benefit you in the short term, again, by displacing some of the costs on the long, is what I just explained. Sometimes you get a perfect situation where one strike expires just before a big move, which is what happened with CVS, and you have the long benefiting all the profit. So that's when I went from $155 total cost. The short expired, all those contracts, and the longs were wide open, and I sold them at like 950 something in open. I actually went a little higher than that, but I was perfectly happy with that. I think about 150 to 950, roughly. It's a pretty fat profit there. They are still limited risk. The short contract, obviously, you want that to expire worthless. So then your actual official risk is the difference to your long. Again, so if it was $1,000 that you paid for the long and $500 you sold for the short, so effectively costing you $500 to open the trade. All right. Unless you built it separately, then of course that varies. There's a cool trick on that too, that you can actually have a completely free trade. Depending on your actions of the trade management is what really negates that last piece. All right, things to know with calendar spreads. You must, again, buy time. So you want to have not too short expirations, but not too long. You need to be prepared to open and close the trade. All right, don't think that you're just going to just let it ride to expiration. It's not how this works. Open the trade as one unit is the preferred way. Again, because you don't want to be trapped in a position that makes a stellar move in your favor, and then you don't have the cash to close the short to sell the long. And I mean that by because you have to buy back the short. Whatever the value is, if you want to sell that long, you have to buy the value back. When you open as one unit, you can effectively close the entire position. Your expirations really need to kind of be planned out. So if you expect the move to get here, but not quite to this other level, that's where you really want to sell it, somewhere around there. If you think your move is going to take place 1 to 2 months, plan accordingly. Buy the long call of, say, and in my example of CVS here, because that's what I was doing, call, say, of $80 on CVS, and then sell the short call for $80. That is an official calendar spread. And I'll break that down in a sec. So this means you don't think it will be 80 within a month, but definitely 2 months. And you can close at any time because it's a single built position. So that means you're buying and selling at the same time in one transaction. There are multiple types of calendar spreads, so horizontal and diagonal. Horizontal is the official 80 to 80 here in this example that you see. And diagonal, of course, is what I do more often to get better returns. Because, again, if there's a gap between the contracts, the wider that cost difference is, that's more profit that you can reap, okay? Obviously, you're going to pay a tad bit more, but once it hits, like, say you get a huge move, for example, Boeing, we're going to earn a lot more money on that long, and that short's going to expire rapidly, and it's going to be fantastic. So the horizontal is buying and selling the same strike at different expirations. That's counter spread. And then the diagonal calendar spread is buying and selling different strikes at the different expirations also. So different strikes. So you're not going to buy the same 80 and 80. You would buy 80 and 85 or 75 and 80 or something like that. If you buy and sell on the same expiration, then you open a debit spread or a vertical spread. Keep that in mind. Don't confuse calendars with verticals or debit. These are the greatest spreads in my opinion. I wrote books on these. Iron Condors I've used on a few occasions. My books are the absolute best way to describe these because I've put a lot of detail on these books. Cover Call Magic and Armored Cash Cover Puts on Amazon. If you hit the link tree up on, actually I'll post it to the Discord as well, but it's on Instagram and you can go through there. You can go to all the links for the books. So selling cover calls. So before we get into this, let's go back. I know we're going to run on time here, and that's okay. I'm teaching you guys a class, so I'm not going to cut it short on you. So let's hit my portfolio up real quick. Again, look at the month return on this. Of course, that was a huge day here. Didn't get to cash that out just because of some other circumstances because it dropped on me. So let's see. The week was pretty good. It was looking real great right here. And then, of course, position moved back against me. So roughly 23% this week. And that was a pretty fat return. So if you look at last week, let's see. The 5th is when I bought my wife's car. Yeah, so right here, about 1355, right? So it was 800, and then I had doubled it up to roughly, I think it was 16-ish, 1700, and I added a little bit of cash. But anyway, let's go through my plays here. As you can see, this is what happens when you build a position separately. And we'll go ahead and cover this because it's quicker. All right, so I bought these long calls. I actually posted this in the chat as a naked trade. I said I may sell calls later. In this scenario, this would have been one of those free trades because as you can see, my average cost per contract was only $60. And if we run back to the portfolio, you can see that my sold contracts, I only got $35. And this was right before it blew up too. So had I sold them for what they were worth the other day, let's see, $131. Okay, so this was the other day when SPY completely just blew the moon off, right? And $131. Had I waited for these credits to come, I would have received $130 per contract set out of 6, which would have netted me 6 times 100. Obviously, 600, 6 times 3 is another $180 on top of that. So I would have been credited $780. All right. How much did I pay for the other trade? Well, let's go look. Well, 60 times 6, so roughly what, $360? So look at that. I would have literally been credited 100% return just for opening the trade the way I did. Okay, you literally, and I've done it several times now, paid nothing for that trade had I done it that way. Now, granted, I didn't think SPY was really going to push up as fast as it did. I had an opportunity to buy these contracts low. It was somewhere in here. They dropped down. Let's see. I think it was right there. Yeah, so they were down like the 20 range. So I was just expecting to get the credit. No big deal. Anyway, I missed that. No worries. So, well, these SPY calls, but you can clearly see, okay, so I'm $119 profit here, but I'm only losing $79 here. And the longer it takes this baby to get to 400, the better, because that means these are going to slowly start to expire. And of course, I netted the 174 back on it, so they were way down based on this huge run that they had. No, but keep that in mind, because what I could have done, all right, and this is how I did with Nokia. So I bought the long calls. Now, had I bought one more call, let's say 60 or $70, I could have waited, okay, and as soon as these solds hit this level of 130, I could have sold an additional call, and that 130 would have averaged into this price, thus increasing my average credit per share, giving me more money when they expire. I still don't think that SPY is going to be over 400 by the 17th, which is only 2 days away. So I'm going to rapidly get this credit back. Okay, so I was received $209 total dollars, and if SPY is under $400 on expiration on good old 17th, which is Wednesday, because today's now Monday, it's going to be fantastic. All right, and I'm going to collect that entire $209, and then guess what I'm going to do? Say SPY jumps up to $399, I'm going to turn around and sell these bad boys right here, which expire on the 19th. I'm going to sell them for whatever profit value I have at that point. So if she gets up to $399, it should probably be about a 60 to 80% return at that point. And again, I call this out even for the free people that aren't paying for the premium. All right, now let's look at the better ones. Wayfair. So I've made great money on these trades. I've already placed a limit sell here for $900. That's roughly the value I'm seeing with these, and that's why I've been trading the same strike price. So 26 to 19. So check this out. So on the 19th, if Wayfair is still under 325, I'm going to rapidly get this $835 credit. Sorry, let me go ahead and put this back together. So there we are. I received $987 from this credit. Okay, I'm up 15% right now, 150 bucks, and it shows you the break even price is 334, which I'm not worried about that because I just want it to be under 325, and that's completely receiving this entire credit. So if we scroll on down to the contract creeks here, we can see that theta is $126 a day, roughly 127 at this moment. Now, when the market opens tomorrow, or later today rather, it's actually going to probably increase on the theta, and it's going to eat this contract away even faster. The best thing that can happen to me is Wayfair gets up to 324-ish and then just goes flat. Therefore, my 325 is going to be wide open on the long. And guess what I can do? I can either close it for profit. Now that I know they're going to sell it automatically anyway if it's in the money on expiration. So if it's above 325 on the 19th, chances are Robinhood is going to go ahead and pre-sell this position for me, and I'm going to get whatever profit value is currently at the face. And being at 3 o'clock near expiration, it's probably going to be pretty decent. So now, if 325, I buy it back super cheap, or if it expires worthless, then guess what I have? I still have this 325 that's wide open. Now, it would be in my best interest to sell it at that point because it's only 1 week away. And of course, Theta is going to start beating that contract down unless Wayfair goes up. All right, so real quick, pop Wayfair on the chart. 370 was the, looks like the good high. We're building some decent stuff going on here. It's not quite a bear flag, so that's a good sign. It's a daily chart. We look like we're building support, but it's right at that 315, 318 resistance area. So with that being said, you got to keep that in mind. You don't want to be sitting here and watching it get rejected, and then your other contract just fades away. Okay, so I mean, super consistent money on Wayfair the last 3 times I've traded it. It's pretty awesome. I missed the huge run up, but I sure enough caught the run down, and I also caught the last few pumps from the bottom. FSR is kind of a wishy-washy trade, super cheap, only costs $32. I'm expecting a decent move on FSR on Fisker. I don't know if we're going to get it, but it's possible. Let's go ahead and pop FSR over here. And at this point, we're kind of doing just like a basic rundown. So 31. There's a little bit of potential to run up here. Possibly not, but it's very possible. So we could wait and see. It looks like it's breaking down, so there's a huge possibility to retest this 20 area. There's no gaps, so that's a good thing. Oh, no, I'm sorry, there is a gap. So right here, oh yeah, 1750. I had shares the other day, that's why I sold them, because right here is not looking good. Take that away. Pop a 150-minute chart. Yeah, so EMA is turning back down, so chances are we could probably do some FSR at the money puts because you're going to get the most return for the at the money on these. Matter of fact, let's see. Let's go April 1st. Let's be smart. Boom. Let's see. All right, so 20. You could say 20 again. My target was 1750. So if we're going to April, that gives us a little bit of time. I mean, look how cheap these contracts are now. If we're expecting 17, you want good Greeks though. This is only $12 for the Greek. That's not great. You're looking for 30. 30 is ideal. Of course, it's going to be closer to the money. So this 21 would be perfect. That's what I would do, and then I would turn around and sell a put for. Let's see, March 26th for. So you already got a 21. Probably the 20 because it gives me a $100 split, but at the same time, it's a 4-day difference on the expiration. But it's only going to cost me $90 now instead of $177. And guess what? If FSR stays sideways or touches down to that EMA and just bounces off and is not ready to fill the gap, then guess what? That 21 is going to go down real quick. Or 20, I'm sorry, it's going to expire real quick. Or I'm just going to go real cheap. I'm going to buy it back. Okay, and then I'm going to let the 21 put do its job. So then I have April 1st on that. And I'm looking for a little bit more down. All right. Let's go back to the portfolio. I mentioned Boeing several times, and we're going to see. Let's see, and I'm going to show you what I meant by looking at the whole position as a unit. So this is 2 different positions here, right? So you got the puts, and then you got the calls. So I bought a 285, sold a 290 call, and then I bought a 260 put, and then sold a 260 put. So this is a diagonal calendar spread. This is a horizontal calendar spread. All right, so you got to understand the difference there and look at the stock price. So I bought decent expirations on these, but nothing crazy. But look how much premium there is potential here to earn. If Boeing stays around this area, these contracts are going to rapidly increase and decrease in value at the same time. It's going to be pretty great. The closer it expires flat, and matter of fact, I'll put this on the options calculator. It's just a lot easier to understand. Let's go calendar. Let's pop Boeing in this baby. All right, so 269. So it is an accurate price. So make sure that the price is accurate. 269.63. That's good enough for this example because it's after hours price on Robinhood right now. So let's select our option. So we had, let me go back and make this easier. So let's go with the puts. Okay, so being that it's the horizontal, let's look at 423 by 260. So 423. And we are buying the 260 put. And of course, you're going to change your costs and or credit based on what you actually did yourself. So we're selling 260.16 just to verify. On the 16th, 260. All right, and now we're going to update our costs. So you can go to your contract, put in, I got $1,210 credit for the sold 260. So the right. So it's at 1260. Okay. I'm sorry, 1210, not 1260. All right, so 1210. And then we'll go here and change this one back to 1375 is what we paid for that one. So let's see, it's $100 off. You always got to make sure you update your stuff so you know the exact piece that you're doing. So you calculate it out. So I paid 165 for this contract, and you can see, we go back to the set, that is exactly right. Okay, so now that you know how to actually calculate this, there you go. Stock price range has been trading between 247 and 292. That's where you really want to stay. And you can see, look at all this greenery. All right, the higher it goes, the more negative it goes, closer to expiration time. However, if it stays mostly in this range, look at the profit. You're still making great profit. Ideally, you want to be right here, right? So right at about the 260 range. That's going to be your highest profit potential there is. 292% return. That's pretty great. Let's not kid ourselves. What the target would be, and which is great, is because I expect the price to stay somewhere in this range. So either way, look at the returns I'm making. Okay, so $135 here, and I have just one set of these contracts. Sometimes I'll average in and get more, but I like the way it's working, so I'm expecting to sell this at roughly $250 to $300 something. Obviously, the more contracts you have, the more profits you're going to have. But basically, even if Boeing goes up temporarily, but settles back down into this range, that's where our profit potential is going to be because it's at expiration now, and it's going to be rapidly growing value. But here's the best part. You have a shorter expiration on the sell. So let's look at 416. So let's see, right. I think my expiration's right. 23. Perfect. There, yeah. Okay. So that at that point we're gaining this entire credit. Sorry, just making sure I was reading it right. So 416, that's when that contract expires, and that's when it's going to really start to hit up. So let's see, 260 expires worthless, and that's where you're going to get all that value from credited to you. And that's what we're looking for. So now let's take the vice versa. Yes, we're running a little over time here, but that's fine. All this is recorded for those who are not watching. So notice how it says BA260 puts, and it's showing that it's it's debit, but you can see it's clearly defined as a calendar spread here on Robinhood, right? Now you go to this one, and this is at different strikes. So look what it calls it: 2-option order, or they call it a debit, or 2 debit order, something like that. So what you need to do is realize that, look at the bid-ask spread. So it's really not that bad. So 240 to 310, average 275. 277 is what I paid for it. So we're actually looking really great right now. So let's go ahead and do 416, 285. And these are calls. So hopefully you see that right there. That's where your credit really comes in to play, is because it's expiring and it's getting more and more money in your pocket. But it's also calculating theta against it. Options profit calculator is super awesome tool that you can use, and just make sure that you're using it efficiently, right? So let's go ahead and select option here. What was it 16 and 9? So 285 on the 16th. Calls. Make sure you're on the right side of the spectrum. And then so we're going to the 9. We're buying the 290. Let's make sure I got it built right. So we bought the 416, 285. So we bought the 216. I'm sorry, the 285 on the 16th, right? And then we're selling the 9th at 290. Because I don't think Bone's going to be at 290, let's be real. But 285 is very possible. It's very close. But notice my contract difference here, 416 to 49. So you got about a week difference, and you have a $5 difference. And look at the value difference. So you see a $300 change in the stock price, or in the options price already, just between these two at open. Just go ahead and make sure our costs are effectively marked. So 715 credit on the sold call. So it's pretty close. It's pretty close. 720 is what it shows. And that's after theta started beating it down. All right, and let's go back to the bought call. 285. 992 is what we paid on that one. So 992. And yes, you have to put your decimals in, otherwise it's not going to calculate correctly. All right, so 277. And once you hit calculate, this is your money. Okay, and now remember, you want it to be bullish, but not crazy bullish, but you can still move sideways at the same time. Because even through here in this mid-range of expiration, it's actually still increasing in value. I mean, 17, 18, 20% on return. Over here, look at that. That's what you want. If you get near the money, this is what's going to happen. You're going to start gaining all of that credit here as it gets closer and closer to expiration. You're not going to lose any money unless it goes down, okay? Because it still calls. You still want to be bullish because you're buying the 285. And this is where the calendar works, because as this price decreases, as long as it stays up here in this range, because again, I am bullish, but I'm not being crazy about it. I'm not thinking we're going to 350 right away. But that move the other day was very big, okay? So keep that in mind. But look at this. So we're expiring near 290. We're going to have a huge return, 245% on the other side. You guys see the difference in debit spreads, naked calls, naked puts, whatever, versus counter spreads. So this is a huge profit potential return. Imagine doing this, and let's be real. Let's put it down here somewhere. Let's just say you're averaging a 50 to 80% return, and you're just trading these on a month basis, 50 to 80% return. Okay, let's say you have a $5,000 account. You know what? Screw that. $1,000 account, and you're risking, say for these trades, both of these trades are less than $300. Okay, primarily the put one, so it's closer to the money. It's actually cheaper. Let's see, yeah, so $165. So if you got a $1,000 account, this trade is nothing, right? It's 165, a very small portion of your account as a whole. And if you look at the other one for Boeing, it's only 277. So yes, that's about 30% of your account, but at the same time, it's $1,000 and $277 contract. Now let's say you wanted to go all in. Okay, you know what? Boeing's gonna move big, and I need a decent expiration because Armor Bull was like, "Yo, get some expiration time." And let's just say you're projecting the same thing I am. Say you're projecting April 30th for $300. Well, first of all, these are crap because there's no open interest on it. IV is 51% for Boeing. That's not bad. Your delta's still decent though. Okay. Now, yes, if it runs to 300, you're going to make a lot of money on that contract because you still have time. You get about a month and a quarter, a month and a half. However, you're paying $890 now. Bid ask is pretty wide. It's about $180 on the spread. That's not really great for you, okay? Because worst case scenario, let's just say you're really confident and you actually do get in somewhere for this. You've just risked your entire account on one contract out of the money, even though you got a month. If Boeing stays down here in this range and just moves sideways, you're just constantly going to lose value. This theta is only $18 here, but it's going to continue to go up and up and up the closer the expiration gets. 2 weeks from now, this will probably be around 50 or 60 bucks if it's in the same price range, and possibly $100 if the last 2 weeks, which is just going to destroy your contract. If you're in Arbor Bull trading, obviously, if you have access to the main part where I show the signals, VIP signals, which is here, over here, Arbor Bull. VIP signals. This is where I post all of my trades. The Sniper should be posting his here as well too. So as you can see, we were talking about right here. If VA closes below 238, you know he's going to do puts, and I was like, yeah, counter spread long. Oh, sorry, that was for Workhorse. I'm sorry. I didn't get into Boeing until the end of the day, but I went ahead, as you can see, 300 price target. That was on 312. Today's 315. That was the weekend. So I went ahead and went in. I told you exactly what I bought, what I sold, expiration dates they're on, how much it cost me, what was my price at entry. I try to get all of these, in here at the same time. What kind of trade it is, what stock it is, everything. Okay. When I'm doing it on the computer, it's hard to gap down, so it's easier to do on the cell phone. This is sort of protection against it. Looking at maybe 280 as like a high target if there's a lot of resistance around that next area. But that's why I did the 260s. So then I told you what it cost, and I told you where the stock was when I entered the price. Okay, you can clearly see, clear as day. This is Webull, so I did it from my phone. But I showed you where that price was. We're sitting perfectly pushing off these EMAs here, and the trade is just looking really good. And I'll show you like what I paid for Robinhood. Quick example. So look at that. This is what I put as the limit order, 278, and they only charged me 277. So I saved $1 there. Plenty of these scenarios. Look at that. Put 120. They gave it to me for 118. This is what I was talking about with slippage. Sometimes you get rewarded, right? So that was 35 PLTR, and so on and so forth. Yeah, that one's straight up. I made some money on Amazon too. It's pretty nice. But this is a signal. I didn't take this trade, but I did definitely put it out there for everybody. I love Ford stock. It has great deltas on it. And so yeah, right here. So Arbor Bull Prime Chat. This is where I do all the talking and stuff. So we got some questions in here. And then Sniper Snipe. This is where he's constantly posting a lot of his plays. Now, when we're putting official callouts, which means we have strong conviction in those plays, that will be in the VIP signals. Green Room is kind of just chatting. Hot setups, mostly for charting. I've got a couple of little random messages in there. But VIP, this is where you're looking for the official trades that we are doing. And these are majority. I will take all of these that I post here. All right, now back over here to it. Counter spread options profit calculator is tremendous. Let's see one more example, and then we're going to finish up that last little bit of the presentation. So Tilray, okay, so this is a huge projection here, and of course these are probably going to be in the money really soon. 28 was already in the money, but look at the price strikes. Okay, so 28 to 29, so 430, April 30 is only a month away, right? So we're looking at getting over here on April 30th, and then guess what? I received an entire $705 credit from this. Granted, do I think Tilray is probably going to be a lot higher than that? For sure, but it's okay. Because if I get exercised, signed, I have the 28, which means I have power over the 29 anyway, or even if it was another 29. Look at the credit difference. If Tilray starts moving sideways or flat, I'm going to be earning some money off of this. Theta right now is only $8 per day, but it's going to slowly start to benefit me and benefit me and benefit me. Alrighty. And see, Workhorse the same. So you just look as an example, okay? So you see that 1217 expiration on Workhorse. I'm expecting a big move on them, but I'm still keeping it in reality, okay? So it cost me $118 for this. Went for $20 on 1217, $22 on 1015. We got a little bit of ways to go there just to push back up, but you saw where Workhorse was a while back. It was like 40 before the whole USPS incident where they did not get the contract. So $41. So that's a huge difference. Look at that. So stepping stones all the way across. But this is not good though, because there are some gaps in his charts. and you got to be very careful because you're at 13 right now. But worst case scenario, 420 is what I'll be credited. 543, basically the difference in what I got it for. That's going to be my total risk. So $118. If I started to lose 20% or something on this contract, I would go ahead and close it. But I will say this: with me saying that, don't expect, like, some of these aren't actually negative on these contracts. These are actually, Wayfair was positive before close, but the contracts change a lot at close. And let's just use an example. Look at the bid ask price. That's $280. And if we go back to the other one, that's another $200 roughly. So you have to keep that in mind. The bid ask changes a lot when you have longer expirations. So one more time, let's see. So I expect to make money on all three of these. These are potentials. Workhorse and Tilray, I do believe will make some money. PLTR is a little different. SPY, 100% going to make money on this trade. And FSR is sort of a, slight speculation trade. I could have sold it the other day for a couple bucks, but I'm looking for a decent move pretty soon here because it keeps getting upgraded. So far, good news about it, but we really need their money to come into play. I mean, look at that right there. Let's see, a month ago, you went from 16 up to 31. So it was a huge move, and it settled back down. So are we going back to 16? Or are we going back to 31? We'll find out soon. But if you were posted when I sold my shares, I told you guys I wanted to sell my shares, because I didn't feel like it was going to hold strong, and sure enough, it didn't. So I actually sold my shares at a good time. Sold them at 24. Let's see what day it was. Yeah, sold it right around in here. Yeah, because it pushed up to 25.50. I actually sold it somewhere on this run-up candle, and I actually made about $500 on the trade. Nothing crazy, but it was enough to get me out of it. And then now you see it's at 23. So EMAs are crossing back down. So real quick, let's finish up this presentation, and we're going to call it. All right, selling covered calls. Again, I wrote books on these. I'm going to post it on my IG page, and I'll post it back in the chat again. What is selling covered calls? So think about what we're doing, right, with the calendar spreads. You're buying a contract and selling a contract against it because it's, guess what? It's representing the price for 100 shares. So for every sold covered call, that means you're holding 100 shares in place of it. So what is selling covered calls? Covered call selling sells the right. So listen carefully. Sells the right to someone else in exchange for cash, meaning the buyer of the option gets the right to own your stock on or before the expiration date that you chose at the strike price that you sold. So if I buy 100 shares at $10 and I sell a stock option for $15, I'm expecting it either not to hit 15, and if it does, guess what I do? I make money not only on the premium I receive, but when the shares sell, I just made $5 per share. 5 times 100 is $500. Okay? Very, very simple here. Why sell cover calls? You own shares already and you want the premium. You're buying the shares you want and then sell for an additional profit against them, which is what I just explained. You're short-term bullish on the stock and want some protection if you're wrong. Okay? Risks. Maximum loss to zero of any stock you choose, of course, because guess what? Stocks can go to zero. And stocks can go to infinity because numbers have no end. Are stocks going to go to infinity? Of course not. But for people who were selling calls on GameStop, of course, they got assigned right away when it went on this ridiculous run that it did. And those people made premium. Hopefully they sold at a good strike price, and they got a lot of profit in between. So stock can lose value where you're still holding it, of course, and therefore your sold contract will actually be in your favor. But if your long shares start to lose a lot of value, that can actually negatively impact you as well. Don't spend the cash you received unless you're really confident that the sold call is going to be good for you, right? In case you need to buy back the position on emergency news, to get out of the shares before something bad happens. Because you sold the call, your shares don't go anywhere. So then you're stuck. Yeah, you receive a little credit from your shares, but at the same time, you can get destroyed if the shares go to crap. Something like Hertz filed bankruptcy. Same as a poor man's covered call, which aka calendar spread. So get some tendies. Iron Condor example here. You need the stock to trade in a pretty decently tight range. I'll just give two examples here. So basically, you're going to sell because your range is the outers, right? That you're buying. So you're buying the 84, okay? You're selling the 83, all right? And this is for puts, all right? So it's going to only credit you $40. So your risk on this, you can do defined risk using that other calculator. And what you're looking for is the stock really to stay somewhere in this level. And it's going to give you a decent little credit there, but nothing crazy. This is a very common pattern, of course, double bottom, double top. So obviously we see a W, and we see that huge on last year for SPY. You saw for NVIDIA, Shopify, Tesla. So many stocks put this pattern out with the W. So W is for winner, M is for murder. Okay, so keep that in mind. Do not get tricked in a double top. Now, what happened with Boeing? We just discussed that earlier. We saw a double top potential, but guess what? You didn't see. It didn't stop. It blew right through that range and just kept going. All right. So this is another example, just different strikes of the iron condors. Take this in, and your credit is crap, but your probability is high. Okay. And you see kind of the breakdown here. So this is the sold one, and here's the bought. So you're kind of just building a range that you want the stock to trade in. So you can kind of see the gap where you're at. So you're out here at 86 to 87, the call side, and on the put side, you're at 77 to 76, and the stock was currently trading at 81. So that means you want it to stay right around the 81 area. So you can benefit on both of these sets. You're going to receive the credits versus buying the contract outright. Okay. So if you calculate that out, you can understand how you got that $13 credit. I've only used iron condors just a few times. They do work. It's on Ford, and it's been quite some time. I don't trade them regularly. Counter spreads are just so much better as a trade. Moving on. And again, if you follow my IG, you've probably seen this. Your fear of failure, right? Which is the stone you're leaping from. Your goals, trying to get that bird, taking the chance you're just leaping off, aren't trading. Now, of course, this photoshopped picture here, but you can clearly see that knowing that looks can be deceiving. So would you rather be successful because you took the leap, or watch your goals pass you by, which is of course the bird. So if you don't take that, jump to try to learn all this stuff, actually learn how to trade strategies that actually make sense, you're not going to get trading, and you're going to probably give up. If you trade naked options and that's all you do, and you don't try to learn anything else about trading, I'm not going to say I promise you or guarantee you, but it's going to be very difficult for you to really reap benefits from trading, because it's not something where you just buy calls, buy puts, you're fine, right? Because that's not how it works. The one day you can make money all year long, and then as soon as you get to the end of the year, you're still trading the same strategy you've been using, and it works amazingly, and all of a sudden the market does some crazy stuff, and you just get destroyed on your positions. Now, depending on your risk factor, were you risking appropriately to your account size, et cetera, or did you just happen to go all in on this trade and you got stuck in just this big oh man moment? And that's what happens. All right, Armor Bull trading. Again, this is going to conclude our presentation here. I do thank you all for being a part of this. I know it was longer, about 2.5 hours here. All my trades are listed here on this Robinhood account. This is what I use to trade as far as I can't bring Fidelity up because my accounts are shown number wise, and I don't want this to get out to the wrong people and my accounts get hacked or stolen, whatever the case. So you see all these trades here. I went through them one by one. If you have any questions, feel free to ask now. Looks like we only got Austin in here. Austin, do you have any questions?
I'm good, man.
You're good. I know it was a lot, man. I know it was a long, long
Yeah,
class. I just hope
I'm
the
tired.
information. I just hope I appreciate you sticking around for me. I just hope the information was good. Again, this will be recorded. I will go ahead and send the link tomorrow after it clears through Zoom, and I'll send it out to you guys. So if you share it, obviously there's plenty of information here. I'd rather you not share it because I like to individualize, each class. With this one, I didn't have many participants that actually, nothing against you guys, but Didn't ask a ton of questions, but I feel like the questions that were asked were pretty good. So I feel like I covered a good bit of information there.
All right. Thanks, man.
Yeah, of course. Have a good night, brother.
Have a good one.